barring just getting the hostages home. After that, the goals have not changed. The animosity, if anything, even larger. How are we going to resolve this?
No, we're not going to resolve it. We haven't resolved it since I'll go back to 67, and other experts would go back to 1948 or before. But to your point, Lisa, I thought you were quite good on this in the last couple of days. The day-by-day ceasefire, even with certain violations here and there, has to have a cumulative benefit to all. But then it ends. And I have no idea how close we are to that phrase.
Yeah, let's see when it ends and whether it gets extended. That's going to be a big part of the conversations today and into tomorrow. Turning to the big story of the last 24 hours in this market, the Fed rate cut debate, the conversation. Fed rate cuts could come as soon as the first quarter of next year, according to billionaire investor Bill Ackman.
I think there's a risk of a hard landing if the Fed doesn't start cutting rates, pretty soon. So, I think the market expects sometime middle of next year. I think it's more likely probably as early as Q1.
That's Bill Ackman there, the full conversation with Bill Ackman on peer-to-peer conversations with David Rubenstein on December 6th on Bloomberg TV. I kind of understand what Bill is saying here, Lisa, that if you are worried about the cumulative tightening, if you want to time this perfectly, which I think is near impossible, but ultimately you can understand the reasoning as to why you'd have to start easing earlier than perhaps the Federal Reserve is willing to engage on this particular conversation.
Agreed, which is, I think, what the market is kind of feeding into as well. What I find interesting is just that Bill Ackman got a ton of kudos after calling the market perfectly, saying he was shorting bonds in September, closing the short in October, and then riding this. So how much is he basically just trying to perfectly calibrate the emotional mood swings of the market right now?
We had to go out and find someone who could perfectly calibrate. That's Eric Nelson joining us now, macro strategist, Wells Fargo, and particularly on foreign exchange here. Good luck with that, Eric. Perfectly calibrate dollar trajectory for next year. Do you have a clue?
Well, Tom, the key here is, we're coming into the year and there's a lot of, I think, hope and consensus for continued dollar weakness throughout the balance of 2024. I think we're happy to sort of play for that in the next 1 to 2 months. We are seeing a positioning adjust that's still quite long dollars. The Fed clearly becoming more comfortable with rates where they are, maybe even sort of shifting toward an eventual pivot. The question for us is, if we're going to end up in a broad-based global slowdown by, say, Q1, Q2, including the U.S., is that really an environment where you want to be short dollars? History says probably not. So I think you have to be very careful, and I think relative value opportunities, shying away from the dollar over the balance of 2024 may actually be the best course of action.
Eric, I'm going to give you a softball. It was your outlook that was put out about 10 minutes ago. I shared it on air here on Bloomberg TV and radio. Goldilocks and the 5 bears. Eric, can you tell us what the 5 bears are?
Yeah, it's a couple things to sort of keep in mind here, John. I mean, one of the big ones is the global growth slowdown. I just, as I just mentioned, but there's a couple other things to sort of keep in mind. I mean, the big things here are, election calendar, certainly a big one, broad-based rate cuts across the G10 and EM and carry compression. And so I think those are the really big ones to focus on as we get into 2024. Question for me is, at what point do these bears kind of rear their head? I'm really looking at next week's U.S. jobs report. That is the big one, and it's sort of going to tell us, are we going to see an earlier turn to rate cuts, an earlier turn to global slowdown risks, or are we going to get another 180,000, 200,000 number, and we're going to continue to push out this rate cut outlook? And that's sort of where I think the near-term risk is for all these outlooks, including our own.
Eric, how on earth is it that binary going into year-end?
Well, I think we've seen a big move in positioning, John. So you look at the move in rates, you look at the move in FX. Yes, there's probably more room to go if you have a situation where it becomes clear. You look at Waller's speech yesterday, a great example. He acknowledged the pace of job growth is still okay. And so, yes, we've seen unemployment rise, but initial jobless claims haven't moved that much higher. And these extreme moves we've seen both up and down in rates and FX would suggest that there is room in a low liquidity market to see some pretty wild swings into year end.
So how much are you calling with conviction to buy the dollar versus just simply don't write it off, that it's just not going to be a clean trade no matter what you do?
Yeah, I think, well, and to clarify, I think we're not at a point yet where you want to be long dollars. I think for the next 1 to 2 months, our base case is still continued slowdown on the labor market side in the U.S. Inflation stays low enough to give the Fed comfort to keep rates where they are, maybe start to hint at eventual easing. But yeah, as you get into crystallization of some of these growth risks, especially versus some of the higher risk currencies, I think that's where you can start to look at actual tactically outright buying the dollar versus some of these more risk-sensitive pairs.
Is there a sense that some of the strength in the U.S. can continue, and that even if there is a rate-cutting cycle next year, and even if it starts in the first quarter, as we just heard Bill Ackman predict, that at least the U.S. will be cutting rates less in 2024 than, say, Europe?
Yeah, and well, I'm glad you brought this up, Lisa, because I think there is, in most normal times, non-recessionary times, FX is all about rate differentials, right? That's really the key. What becomes a little more complicated is in these global recession scenarios, that relationship can break down. Look no further than March 2020, when you saw rate spreads and the dollar move in completely opposite directions. So I think even though the Fed is probably going to end up cutting rates more than the ECB, given starting points, real rates, et cetera, it's not necessarily going to be euro-dollar positive. At the end of the day, I think we're going to see more consolidation in euro-dollar once these recession risks are crystallized.
Eric, great to get your view. Congratulations on finally getting the outlook published this morning. I know that's difficult sometimes. Eric Nasson there of Wells Fargo. Difficult to get everyone to agree, get everyone on the same page as to what
some houses
like
do that. Some houses want that, but other houses, like Morgan Stanley, is very fractious. You know, they really
bit more
get
division.
Going. Yeah.
Need to turn to GM.
Yes.
GM, what a troubled
Bombshell.
stock. The stock is basically where it was 10 years ago.
Yes.
The multiple is at about 4 times less than 4 times forward earnings. The TK, the name, the market cap is less than 40 billion, and they're trying to do something about it this morning. The stock is up by 5.4%, so we've got a hike to the dividend, buying back $10 billion of stock, spending less on the robo-taxi unit as well. A lot of pressure on Mary Barra.
To me, it's a lot of pressure on Mary Barra, and way, way more than that. This is a bombshell for every CFO in the Standard & Poor's 500. There are 493 CFOs. They will go over this with a fine-tuned comb. Just to give you perspective, Amy, give me this banner. It's so important on TV. I'll tell it on radio. If you look at the debt of the Magnificent Seven, GM, with their leasing and all that, is 72% debt. Apple is 4%. And yet this is a use of cash announcement like you'd see from the Magnificent Seven.
So we seem to be trading, Tom, on, I would say, the cut to investment in things like rubber taxis, seem to be moving higher off the back of the capital return program, reinstating guidance. And just to get your hands around the new guidance, Lisa, net income will now be between 9.1 billion and 9.7 billion. The previous guidance going into these strikes, a range of 9.3 to 10.7. Of course, during the strike, Lisa, they had to withdraw that guidance. So new guidance just a touch lower. What do you make of this morning?
To me, $2 billion in fixed cost reductions. Yep. To me, the question is the cuts and how much this paves the way forward for others who are facing similar income constraints.
And maybe for more cuts at the same company. Correct. Further down the road. Much more on that still to come. Coming up shortly, Claire Lombardelli of the OECD from New York City this morning. Good morning.
Tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Starting to see lots of different things trickle into the economy, which will make the economy likely fall over next year. A story that I think is going to be very interesting for next year in FX is North America is the center of the slowdown. Asia is the center of the recovery, and Europe sits somewhere in the middle.
This is so important. That was Mark McCormick, the global head of EM and FX strategy at TD Securities. We caught up with him a little bit earlier this week. Coming into this year, the call was the slowdown was in the US. The outperformance would be in Asia, delivered by what was happening in China, reopening, consumers re-engaging with the economy. And then what eventually transpired, materialized, if you will, was the US outperformed and China massively underperformed. The call again, Lisa, going into next year is now for Asia to be the center of the recovery and America is the center of the slowdown, which is kind of like the 23 outlook on repeat.
Pretty much everything about this has been the 23 outlook on repeat. It was basically slowdown, delayed, deferred, the disinflation accelerating, the sort of transitional kinds of inflation, that it's just transitory, reinstated essentially, and people are saying it's going to be a weak first half, but then the second half is going to be good, fueled by rate cuts and fueled by the sense that we've entered the new era.
What would you do if the Fed turns around in early next year and says it was transitory? Just turns around, it was all transitory, and basically tries to give them a nod, give themselves a nod to what they said 2 years ago.
They're not going to do that.
Like
I'm not
some
even
kind of weird victory lap.
They're not going to do that. I mean, the transitory was just tarred and feathered. It's not going to be them, and they're not going to declare victory. They're going to try to be quiet about it, but you are going to hear, we'd achieved a soft landing, or it seems like that. We're going to hear other words, but they're not going to use the T word. Come on.
That's the hope and a dream into next year. Futures at the moment positive by 0.3% on the S&P. The scores look like this. Cross asset yields down again by 3 or 4 basis points. A 10-year at 4.2840. An update on a single name, General Motors GM in the pre-market up nicely. The stock is higher by 5%, $30 and about 35 cents in the pre-market. We'll be catching up with Mary Barra, the GM CEO, a little bit later this morning. I'll be interviewing her at about 9:30 Eastern time. Tom, the news this morning, hiking the dividend, $10 billion buyback. Lisa mentioned the cuts, reducing investment in the robo-taxi unit. There's been some pressure there. Yeah, reinstating guidance just slightly lower than the previous guidance, but the capital return program maybe getting some cheers, the cuts to spending, getting some applause.
On the real economy,
let's see if it lasts.
On the real economy, John, I'm going to say this is the first big announcement of 2024. How many other companies are going to come out with attitude adjustments like this? This is the summation of this, as you mentioned, 1, 2, 3 different ideas. And it's the basic idea here is that this was pounded through to be a new GM, whether, right or wrong, it's not my opinion. I'm not qualified to have a view on it. But how many other companies, like lemmings off a cliff, are going to go, we got to act, starting with what Lisa mentioned.
The bar was low. Let's put it this way. The bar was low.
Huge low.
The multiple on this name. TK, you've been covering this way longer than I have. To see GM trading at less than 4 times forward earnings.
Yeah. Full
the stock
disclosure,
is where it was 10 years ago.
I have, and maybe I was colored, but I was sort of on the eastern Detroit end. It's called Rochester, New York, Rochester Carburetor. I've never owned the auto stocks, and maybe that's my childhood, but it's been such a train wreck for so long. Like Ite Macaulay at Citigroup nailed the ascendancy of GM, but you haven't seen it, John, in the stock price.
And given the labor costs, that development in the last couple of months, how investable are they now, even with that capital return program? These are the conversations we'll have. But I think a lot of this is just skipping over a very low bar, and you see that with Foot Locker this morning. Third quarter comp sales, -8%, the estimate -9.88. Can we get Foot Locker up in the pre-market? Lisa?
Skyrocketing
by 11%. Just kind of beating a very low bar.
Yeah, there basically is the bar to not file for bankruptcy. At this point, this is about inventory unwind and this idea of at least not performing as badly and not losing as much market share. How long can that last in terms of comps for next year?
Going into the open about a few hours away, $26 on that stock, up by about 9%. Let me get you the outlook for next year, according to the OECD, warning of a deepening slowdown in the world's advanced economies, predicting Fed rate cuts won't start until the second half of next year. This is the quote in their outlook. Unemployment will continue to edge up through the first half of 2024. Inflation will decline, allowing for monetary policy easing in the second half of next year. Tom, the outlook could worsen if the effects of tighter policy rates are stronger than assumed or lead to financial stress.
I can't say enough, John, how cautious this view is from the OECD. I would suggest they've been a little more optimistic than some of the shops. Joining us right now, their chief economist, Claire Lombardelli, with her work at London School of Economics, Oxford, and of course with the government of the United Kingdom. Claire, thank you so much for joining us. What I'm thunderstruck by is the duration of the slowdown. You have a 36-month average 2.87% real GDP for this world. Have you seen this before? Is there precedent for the duration of your slowdown?
We haven't seen global growth at this low level, for a period. Obviously, the global economy has previously grown at much higher historic levels than we're projecting here. But actually, what our projections today are for a fairly soft landing, actually, and a smooth landing. That's our central projection for economies as they go through, as inflation comes down and they go through the monetary tightening that we're now seeing.
How alone is a buoyant United States of America? How alone is America in your global analysis?
Well, we've revised up our projections for the US because obviously we've seen stronger data there and the economy is proving more resilient to the tightening that we've seen so far. I mean, they're not alone. Other economies are also, doing reasonably well. Japan would be another example, another country I would point to. And of course, across emerging markets, the picture is very mixed, with some emerging economies performing relatively well.
Claire, you don't expect the U.S. to start rate cuts until the second half of next year, which goes kind of counter to a growing consensus among investors that it's going to happen in the first half of the year. What do you think is going to take so long? Is it that the economy is going to be better than expected, or that the Fed's going to proactively be late to the game of cutting rates?
We've seen more strength in the U.S. economy than people had previously expected, which is part of what's going on here. I mean, there's a lot of strength in American consumers in particular, and so what we're expecting really is it to take a bit more time for inflation to come back to show a persistent downward trend and come back to targets, and that's why we're projecting a longer period of monetary tightening is going to be needed. Monetary policy is going to need to remain restrictive for a period.
You also don't think that the ECB is going to loosen policy until the beginning of 2025, even as we see inflation come down quite significantly. We're going to get pretty soon the German inflation read, and we got earlier today lower than expected Spanish inflation. Why do you think the ECB will be able to hold on to early next year, given that people are talking about stagflation, slowing growth, recession in the region?
I mean, we are seeing slowing growth in the EU, and again, we've revised down our projections there. We are expecting inflation to come down, but to come down sort of slowly, thinking about core and headline inflation. And so again, what we need to see is inflation persistently returning to targets, and that's why we're expecting and advising for a period of time of restrictive monetary policy while that inflation is squeezed out of the system. We've seen record rates of inflation in response to the shocks that the economy's been through, and so it will take some time for that to come back to target.
Hey, Claire, we've got to leave it there. Appreciate the update. Thank you. Claire Lombardelli there of the OECD. I think Governor Waller speaking to a lot of this. Some comfort, at least for Governor Waller. He alluded to this. I think it's highly suggestive in what he said. Tom, some comfort that policy is sufficiently restrictive to get monetary policy to get inflation back down towards target. And I can share the full quote with you. I'm increasingly confident that policy is currently well positioned to slow the economy and get inflation back to 2%. I am encouraged by what we have learned in the past few weeks. I'd love more on this, Tom. I'd like to know what he's looking at specifically.
Well,
something appears to be giving, and it's the pace of the economy.
His esteem is earned out of the research house. It's widely understood among the 12 Fed banks that St. Louis invented modern research. I won't bore you with the details now, but Waller is the distillate of 30, 40 years of Federal Reserve Bank of St. Louis excellence. And when he opens his mouth, people listen. What I didn't hear there, Lisa, was a job economy. And to me, I still go back to their dual mandate.
Well, this is the reason why I think immaculate disinflation is still very much on the table. One thing Chris Waller said, and I quote, "There's just no reason to say you would keep rates really high and inflation is back at target," for example. If inflation gets back down, maybe not even to 2%, but close to it, can they then call the all clear sign and start cutting?
Keep going back to that threshold question. Standard Chartered, Eric Robertson, they say something like 4.5% on unemployment, 3% core PCE. Let's go. This Fed cuts rates. Don't think the Fed wants to be that specific, that precise about it, but close. It's the conversation we're having. Sam Stovall, CFRA, joining us shortly. GM up in a pre-market with a big capital return program and some customer spending as well. Does Sam Stovall like the auto stocks? That conversation up next.
On the next episode of the Business Week Show, imagination.
If no one else is going to buy and protect these buildings and make sure that people on the South Side have opportunity, is there something that I could do to try to acquire some of these buildings on my block?
You know, I feel really bad for young artists. They get swallowed up, spit out like stocks on the stock exchange.
Watch the Business Week Show Thursday nights, 10:30 Eastern on Bloomberg Television or 8:30 on Bloomberg.com or the Bloomberg app on connected TVs.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now. What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
At this period in time on the timeline, this looks like a great time for investors in equities.
I would definitely still be long treasuries between now and the end of next year, but with a nod to the fact that it will be a choppy ride.
What I find the most concerning about the last month is there's been a massive risk-on rally on weaker economic data.
We are now starting to see lots of different things trickle into the economy, which will make the economy likely fall over next year.
I think it's incredibly important to remain invested, even in times of uncertainty.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Typically I would, but I can't even share the conversation in the commercial break.
It's just painful.
Just keep it together, Bramo.
I'm aging.
From New York City this morning.
Always.
Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Your equity market is positive by 0.4%. I want to talk about GM, General Motors, in the pre-market. The stock was up by about 5% last time I looked. TK out with an update to the guidance, reinstating guidance, a little bit lower than previous guidance. The stock now up by almost 7%. We've got a big capital return program, Tom, hiking the dividend, $10 billion stock buyback program, and then you've got some cuts to spending in certain areas as well.
I thought Sam Stovall was interview of the day, canceled that. The interview of the day is you and Mary Barra here in the 9 o'clock hour. This isn't one announcement. This is a multifaceted primal scream from an underperformer.
Is this a change in strategy or a change in execution?
On a financial side, it's definitely a change in strategy, no question about it. Financially, on the making of automobiles, which is a lousy business, I'm not so sure. I'm not the auto guy.
Two things. There's a really important transition here with EVs and who's going to win that, especially given the preeminence of Asia.
Is anyone winning now besides Tesla?
Certain Asian producers, yes, I would argue. They've actually come out with lower cost models and they have bigger pools of lithium and other types of resources. Then there's a question of the cost of labor in the U.S. and what that is doing to margins and how much that's actually pressuring the need to cut costs. In other words, was the UAW negotiations, as you mentioned, John, the last sort of gasp of labor preeminence in an industry that's increasingly looking to transition to something else.
So you've got new developments, you've got labor negotiations. We're talking about a 25% pay increase, cost of living adjustment, all of that. That's no doubt hung over the stock over the last 12 months in a material way, particularly the last few months. But Tom, it's not just about the last few months, it's about the last 10 years. This stock is almost exactly where it was a decade ago, despite some record numbers when it comes to selling automobiles in this country, TK. How do you turn that around?
Well, you're at 17, 18 million. You got the pandemic in the way will be their excuse. But I think it's a primal financial scream. And Lisa nailed it among 40, 50 headlines. A key one here, I don't have it in front of me, but it's a $2 billion cost reduction, which I'm sure is on top of a previous cost reduction. And if every CFO in the Standard & Poor's 493 has to review this release.
And not just about EVs, also robo-taxis. These bets on the future, Lisa, sometimes they're much, much harder to deliver on. Sometimes you have to find out the hard way that it's going to cost you more. It's going to take longer to realize gains from it, and I think we're finding that out on this particular issue.
Yeah, what happens when a robotaxi just decides to stop right in front of an ambulance and not move? I mean, these are the types of things that they were dealing with, and then they had to have someone come and try to take it away, and the ambulance is thinking, are you kidding me? And these are some of the things that are transpiring.
Again, 72% debt, a lot of that is the equipment leasing, the financing of automobiles. I get that, but this is something that every sell-side analyst outside of autos has to review this transaction and look at analogs over to where their coverage is.
The stock is up by 5, 6, 7% in the pre-market. Right now, we're up by about 6.27% currently. Let's get to the scores more broadly. Equity futures positive by 1/3 of 1% on the S&P 500. This rally of the bond market continues. Selective hearing for Treasury investors. Yields down by 3 basis points. Your yield right now, 429.17. We listen to Waller, we don't listen to Bowman. That seems to be the message from the bond market.
We're listening to disinflation, and I think that is the message that we're getting across the board, and you're getting it. Is it enough? 8 a.m. we get the latest from Germany in terms of headline inflation read. We already got one from Spain earlier this morning, coming in below expectations at 3.2% year over year. I don't want to say this, but I'm going to say this, and then I'm going to get pilloried for it. Is this the easy part? It kind of is in terms of, yes, inflation is coming down year over year. What happens next? The last leg, et cetera.
Sure.
That's, to me, one of the key questions.
It's funny you say it, and I'm sorry to jump in.
No, please.
I thought you were introducing me, just, give me some space.
Good.
I'm sorry to jump in. Did I say I'm sorry to jump in? I'm sorry to jump in.
Where's the surveillance cork?
I've forgotten what I was going to say.
No, you were saying with respect to disinflation. I apologize. 1:45 p.m. we get Cleveland Fed President Loretta Mester, who's going to weigh in on all of this. And then 2 p.m. we get the Beige Book, which we're we're all going to be reading. The question really is disinflation in the last mile. Perhaps that's what you were going to go to. This question of not understanding exactly where we are, how far the fight can go, and when we can call victory.
To parse that is I'm going to give Jim Bianco credit here, the stickiness, the resiliency of a 3-handle on inflation.
Yeah.
Versus the two-edness that people like Waller and John Williams of New York are modeling. That, to me, is the forward distinction.
Did I say that I was sorry to jump in? I'm sorry to jump in.
You want to jump in right now?
I did know what I wanted to say. It was actually Goldman, and it was Jan Hatzius' outlook. Goldman thinks the hard part is over. That's what I think is so odd about their outlook. And odd, by saying odd, I don't mean I think it's wrong. I just think it's unusual compared to what a lot of other people thought coming into year end. When Sarah House of Wells Fargo talked about the last mile, as you indicated, Lisa, to get inflation back down to 2, from 3, from 4, that was meant to be the hard part. And now you've got Goldman looking out to next year who basically say all this disinflation is in the pipeline. The hard part is done. And the tailwinds to growth will persist through next year. Not my call, it's theirs. Neil Dutter, as we're talking about this, wrote in, and Neil basically said, this is why, for equity market investors right now, this is soft landing Nevada. You've got Governor Waller basically saying, I need a few more months of this, and we can start talking about cutting rates. And economists on the street can already see what's in the pipeline, and they're basically saying, yeah, you're going to get a few more months of this. I've got no idea what happens beyond that, but you will get it. So the Fed is bound to be engaging in this rate cut conversation, maybe a few months from now, based on what we're seeing in the data.
And that's the reason why if you get cuts in the first half and you get them as soon as the first quarter, as Bill Ackman was saying, how much that fuels risk appetite at the same time.
Sam Stovall joins us right now, Chief Investment Strategist at CFRA. Sam does not have selective hearing. Sam, the bond market does. Governor Bowman, shake it off. Governor Waller, tell me more. Seems to be the approach from yesterday. What did you make of that?
Well, my feeling is that, the interest rates are going to continue to decline on the 10-year yield. I think that they are simply reminding us that high for longer, and I don't say higher because my belief is that the Fed is done raising rates at this point, but high for longer because we don't see it cutting in the second quarter as the street does. We think they'll wait until the third quarter.
Sam, I've got to go here. I talked to Howard Ward yesterday, the giant of Gabelli funds. He's had a terrible year. He's up 41%. Just been really bad. And like Sam Stovall, it's because Howard Ward and Sam Stovall are in the market. And it's been a glorious end to the year. Explain how you stay in the market into next year. Is it use of cash by corporations?
Well, Tom, I like to use stock market history as virtual Valium. And what I try to do is to start by saying, what has traditionally occurred, whether you look to seasonality, whether you look to the presidential cycle, et cetera. And one thing that's incredibly encouraging, but certainly not a guarantee, is that in the election year of first-term presidents, whether they get reelected or not, the market has been higher 100% of the time on a total return basis.
That's not good enough.
Gaining 15.5%. And so, well, you could buy some options, you could do leverage, et cetera, if you want, Tom, to get that excitement. We were talking about autos a second ago, and I was going to say we have very few buy recommendations around the globe, but Ferrari is one that I would recommend for you.
What about GM, Sam? I mean, this is sort of the key question. Ferrari is one story, and they can hinge off of Formula One, and I can talk about it much worse than my co-anchors who can go further into detail. Just the nuts and bolts of Americana in the car industry. How much can you get behind some of these industries in transition that need to effectuate some pretty big changes in order to adopt the modern kind of framework for their business?
Well, absolutely. Not only do you have to respond to the consumers' changing desires, but also the pressure put on these companies by the government in terms of fuel standards, emissions, et cetera. We are neutral at best on the auto industry globally. We do have some buy recommendations based on the pre-interview discussions you guys were having. I would say for you, Lisa, Hyundai Motor is a 4-star or buy recommendation. For Jonathan, Polestar Automotive out of the UK is a 4-star, but GM is 3, Ford is 3, and a majority of the others are holds as well at this point.
All I can say is, you heard me say that I had a Kia, and all of a sudden it's Hyundai by Hyundai. I will just say that. Okay, fine. But I will take this. When you look forward and understand exactly how much much that we can see a broadening out in U.S. stocks, how much what we have seen so far year to date has just been enthusiasm around artificial intelligence. Where is that coming from? Where is that momentum coming from? Is it coming from rate cuts? Is it coming from the end of the cycle? Is it coming from cash, as Tom was saying, coming out with conviction into the market?
I think it's coming right now from the decline in the 10-year yield, the removal of a lot of the uncertainty surrounding what caused it to move up to and challenge that 5% threshold. When you look at the number of stocks in the 500 in positive territory this year, you're looking at about 60%. Everyone talks about the Magnificent Seven, but we still have 53% more of that are in positive territory. If you're looking at the number of sub-industries in the S&P 1500, right now 84% are above their 10-week or 50-day moving average, and almost 60% are above their 200-day. So there's a lot of participation going on right now.
Sam, I got to make some news here. Are the Magnificent Seven, Standard & Poor's, CFRA, 6-star stocks?
6 stars. That means with extra credit, I guess. I think what it means is that we still do favor the growth side of the equation. We still think that there is value in growth in terms of earnings growth expectations for next year. Also realizing that following up years in the market, you actually want to let your winners ride. Because the top 3 sectors in the prior year, when it's been positive, has outperformed the market on average about 60% of the time in the subsequent year, and the top 10 sub-industries were up average of about 17.9%, outperforming the market about 3 out of every 4 years.
Hey, Sam, great to get the update from you. Sam Stovall there of CFRA. Sam kind of joked about Ferrari. Top of the pile, the absolute king of operating margins, Tom, in the auto sector. It's something like 24, 25%. GM's like a quarter of that.
Yeah, I like it. I mean, you have one, and you know, you can get in it. I can't get in a Ferrari. I mean, I can't fit
too
in.
low down.
It's too low down. I mean,
most people, Tom, have the problem of not being able to afford one, but I'm pleased that this is what's stopping him, Bramo. It's too low down.
How's that working on Lexington Avenue, down you know, below 59th Street?
You see much better cars in London than you do in New York City.
Part of it is the potholes aren't too bad.
For obvious reasons. Yeah. If you are just joining us, welcome to the program. Your equity market on the S&P 500 positive by 0.4%. Yields are lower by 3 basis points, 4.2917 on a US 10-year. Big conversation about what's next from the Federal Reserve. We just want to jump from pause to cuts, don't we, Lisa? That's the bias. And everything else is just like, give me some data that supports that view. Give me some views out there that supports my own personal view that they're going to cut soon.
Well, that's basically what we were hearing from Sam Stovall, that yes, you have this openness to rate cuts, and they can see in the market, or you were saying this, that you could see in the market based on Goldman Sachs, that baked into the data, we are going to see that slowing in economic information that will give the Fed the confidence to cut. I guess I have so misunderstood this cycle. I don't understand exactly how housing fits into this. I don't understand the long and variable lags. I don't understand how long consumers can keep spending after we've said month after month they're running out of cash. All of these questions are still looming large.
Right where you went there, the long and variable lag of the pandemic, and I see this percolating. Are we really beyond the stimulus of the pandemic? Tomorrow, personal income, personal spending. I've been so wrong on that. Everybody else has been so wrong on that. The fact, you know, is going to give us another buoyant tone to what the consumer's doing.
Jobless claims tomorrow as well. Then on to next week. It's Payrolls Friday just around the corner. Just around the corner this morning, big conversation coming up. Howard Marks of Oaktree. That conversation about 45 minutes away from New York City this morning. Good morning.
York City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
I am increasingly confident that policy is currently well positioned to slow the economy and get inflation back to 2%. Now, that said, there is still significant uncertainty about the pace of future activity, and so I cannot say for sure whether the FOMC has done enough to achieve price stability.
That was worth a 15 basis point move in the front end of the curve yesterday. That was Federal Reserve Governor Christopher Waller speaking to the American Enterprise Institute in Washington. Your 2-year started this week, opened up at 495.91. That was Monday morning. Your 2-year right now, TK, 469, and on the session, down another 4 basis points.
I'm going to watch for a 199 10-year real yield. Bill Ackman, I think, is dead on about this. The real yield is what the adults look at, and the answer is the inflation-adjusted yield from what, John, we're letting out 3.01%, 2.90%, never got there, 2.06% at a 1.99. Do we turn into a pumpkin? I don't know. It's going to be a big deal.
Is that what happens?
I
thought good things happen.
Cinderella.
No?
Everything's,
Maybe I want to be a pumpkin.
Bramo wants to be a pumpkin.
Yeah,
Okay. Scores look like this, TK. No idea where this is going. Often feel that way on this program.
That's okay.
Equities on the S&P positive, Tom, by 0.4%.
We're going to have to see. It's going to be an interesting time and an interesting 2024 for those visible in the public market and, of course, those in the private market as well. Long ago and far away, there was KKR, 1976, with history made in a style and a method at KKR that was original. Shonali Bassett gets an update from their co-CEO. Shonali, good morning.
Thank you, Tom. I'm standing by with the co-CEO of KKR, Scott Nuttall, and it is a really big day for KKR because they are doing this. They're buying the rest of Global Atlantic, a big insurance company that they don't already own. That is an all-cash $2.7 billion deal, but you're also creating a new unit at KKR that houses a core private equity business.
Right.
If you had to give the market one way to understand what you're trying to do over there, what is it?
First of all, Shonali, great to be with you. Thanks for having me. Really what we're trying to do today is lay out the big 3 growth engines we have as a firm. So you're right, we are buying the minority stake in Global Atlantic we don't already own. We already own 63% of the company, so we're buying the other 37%. Global Atlantic has been a great partnership for us. This is a transaction we did in 2021. The company's more than doubled since we announced the original deal in July of 2020. And it's been highly recurring, a lot of growth earnings for KKR. So that's part one. We are also modifying our compensation ratios. So our asset management business continues to scale. Our run rate management fees have doubled over the last 3 years. So the second thing we're doing is reducing the compensation ratio on fees, making an offsetting increase on carry, and that will allow us to create more fee-related earnings for our shareholders.
You're changing the way you pay people.
In effect, not the aggregate amount of compensation, but we're providing more of the fee-related earnings to our shareholders, a little bit more carry to our people. The net of that is about neutral, but it will mean more fee-related earnings overall. And then the third thing we're doing, to your point, and this is relatively new for us, is we're creating a new segment for the firm. So we've historically reported as asset management and insurance. We are adding a new segment called strategic holdings. And what we will include in there are the dividends that we're receiving and will begin to receive in greater magnitude from our core private equity portfolio, which is a portfolio of great, diversified, recession-resistant companies that we've been building up over the last several years.
KKR, Apollo, Brookfield, they're all buying insurance companies. All of you are diversifying in pretty meaningful ways. If you think about it, it's made private equity by the dollars, by the assets under management, a smaller part of all of your businesses. What does this mean for the future of private equity?
Private equity is still a growth business for us. We expect to continue to grow that part of KKR for a long time, both with respect to the flagship strategies, but also we've created a number of different growth strategies. The core private equity business is part of private equity. It's now a $30 billion franchise for us. So this isn't about an or, this is about an and. We see an ability to grow PE and all the other parts of KKR. And we've diversified meaningfully over the course of the last 10 to 15 years. We're just continuing our way down that path.
Now, what does Global Atlantic exactly do? It seems like what it's really doing is giving you a whole balance sheet to be using to compete on. You've mentioned capital markets is one place. There's been a lot of competition from your industry to the banks. How does this help you now compete in a bigger way?
Sure. Global Atlantic, as you know, it largely issues annuities to individuals. And so if you think about what we do at KKR, we work for pensioners, retirees all around the world, now family offices and individual investors as well. Global Atlantic distributes its products to that same kind of an audience. So historically, we've worked for tens of millions of retirees. We still do, but now they're just in the form of policyholders. And that's our mission at KKR, is to actually do a great job for all those people that we work for. We're not confused about who our bosses are. And so to the second part of your question on capital markets, what Global Atlantic allows us to do is create more synergy. We didn't necessarily see all this 3 years ago when we started our way down this path, but we think there's even more we can do to unlock value between the two companies, and capital markets is just one of those examples.
Capital markets means you might be appearing on more and more deals, lending a balance sheet to provide capital for big buyouts and other leverage loan deals.
That's right, and we're already in that business. So the way that we built our capital markets business is by partnering with the street. So we'll be alongside the traditional banks and investment banks as we built that business. But what Global Atlantic brings us is an ability to expand the vision for that franchise. So there's more to do across asset-based finance, as an example. Or when Global Atlantic does their large institutional block transactions, we can put some on the Global Atlantic balance sheet. GA has its own sidecar third-party capital funds called Ivy, so some can go into those third-party funds, and then we can syndicate the excess through our capital markets franchise as well. Just like we do private equity and infrastructure transactions, it applies to insurance deals as well.
Something interesting about these deals is that you already have told investors this morning that this will add 20% to total operating earnings. You're boosting your targets into 2026 for fee-related earnings. What are the real financial impacts? What can stockholders feel for KKR over the next 2-3 years?
Well, I think what they'll be able to see is we are going to grow all three of our recurring forms of earnings in a much more meaningful way going forward. So fee-related earnings will be higher. We continue to see a lot of organic growth in our businesses. Just by changing our compensation ratios, you get accretion on fee-related earnings. And we think by virtue of what we're announcing today, we can do even more with Global Atlantic, where we invest that portfolio. It's already gone from $72 billion of AUM when we announced the transaction to $158 billion over the last few years. We think we can do even more together. But they'll also see more insurance operating earnings, which we believe are highly recurring and fast-growing. And then we'll have this third element, which will be the core private equity dividends showing up in the strategic holdings segment. If you put those three things together, we think that'll be 70% or more of our overall pre-tax income is those three forms of recurring earnings. And we're going to introduce a new metric around that called operating earnings. And we'll talk about that later today with our shareholders.
Scott, we do have to leave it there. Thank you for joining us on a big day over at KKR. Tom?
Sonali Basak, thank you so much. We're the gentleman from KKR and the future of what they do. We're going to go to Apollo. Is it next week?
We are, yeah. Mark Rowan.
Is it next week?
Next week, yeah.
These are big questions, and it's not about deal transactions and the PR of all of it. It's about 2024 and the free-eyed. In the old days, you'd go, so what's your internal rate of return look like? And a guy like David Rubenstein would tell you, and, you know, you'd massage it, or George Roberts and the rest of it. And now there's so much more invested in the economy that I want to know from Apollo what the energy looks like in all their different distress areas.
Well, typically, Tom, I think what we believe private markets is all about is leverage finance, right? And
leverage.
What Mark Rowan and Apollo are really trying to change is to make you think about private markets as everything on a bank balance sheet.
Yeah.
So the total addressable market is so much larger than people realize. Mark has also got this really interesting framework for thinking about markets, Tom, that because of the indexing in public markets,
yes,
that the alpha opportunities in public markets have dwindled, absolutely dwindled. So if you find a stock that's not in the index and you think it's really fairly valued,
right,
undervalued, and you should buy it, what do you do if no one else does? In 6 months, you sell it. And he's saying the opportunities, Tom, in private markets for alpha are so much higher. So this is what we've got to talk about next week.
And then the other question is also with Gensler and the likes of Gary Gensler, how do you regulate private markets? In the old days, it was simple. You had a private memorandum, and either you were an adult and did it or you didn't. Nowadays, the overlap here is extraordinary.
So Jay Clayton, formerly of the SEC, we'll catch up with him at Apollo next week.
I did not know that,
yeah.
really.
It's going to be a nice couple of hours to go through some really big issues. You'll be there.
Okay.
You'll be there. I'll come and pick you up. I'll make sure you arrive on time. That's good. It's not looking encouraging, is it, Bramo? Not at all.
Am I going to be there?
You'll be there too.
Okay, great.
Okay.
You can pick me up too.
Do I have to dress like a private equity guy? You know,
What does that look like?
No tie.
No tie.
Can't have a tie.
No tie. Cardigan?
Should we go without a tie?
We can go without a tie.
It's good.
Love to see that bow tie.
You can wear a Patagonia thing.
Is that what they wear?
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Some people might say that insurance is a boring business, but is that not the case?
No, I find it very interesting. I mean, you're not doing the same thing all the time. I liked it because it had a balance of doing different things at once.
Pushed out a really small day of gains on the S&P 500. This morning we add to them up by 0.4% on the S&P. The Nasdaq up by 0.5. Small caps looking good, up by 0.85%. Big conversation about Governor Waller and rate cuts in the bond market. A move yesterday down 15 basis points at the front end.
Look at the 10-year right now.
Tom, look at the 2-year, 469.91. We started the week in the 490s. Big turnaround. We're down about 4 basis points at 469.91. The 10-year, middle of October, I think October 19th, through 5%, back down to 428. 98,
And
down
still
another
above,
3 basis points.
I opened the show with this, John, still above technical support. So the next moves in these yields are really critical to a lower level. Do they breach that support and find a new area on the vicinity of 3%?
So monster bond market rally, yields lower, push it through the FX market. Euro looks like this. The euro against the dollar. Euro strength over the previous 4 days. Bit of weakness this morning, 109.83 is that. At the end of the month, if we basically closed right here, right now, we'd be talking about the best month this year for the euro, Lisa, against a weaker dollar off the back of that bond market move.
And it really has been a weaker dollar move based on those rate cuts that you're talking about. It's also with respect to better than expected data coming out of Europe. But again, the staying power of this. At what point do deeper rate cuts signal something negative rather than just a relief to people who are investing in riskier securities?
Is it negative about the US economy or the global economy? Because that's going to matter a heck of a lot to that dollar call.
It seems like people are looking at the U.S. economy as somewhat divorced. Whether it is put together is going to be a key question, especially since people are betting on the resurgence of China. It's all head spinning. If you're kind of confused listening to me, you're not alone.
Last year on repeat, the resurgence of China.
Yep, pretty much.
Last year on repeat. We've got a great guest on foreign exchange with us, so let's go through some top stories before we get to him. Under surveillance this morning, talks underway to extend the truce between Israel and Hamas as the deal reaches its final 24 hours. Both parties accusing the other of violating the agreement yesterday, but the deal holding as Hamas released 12 more hostages. Secretary of State Antony Blinken will arrive in the area later this week. We mentioned this in a previous hour. I think it's worth going over again. You've got accusations on both sides in the last day, previous 24 hours, Lisa, that either side violated the truce, the framework for this agreement, and yet it holds. Is that encouraging?
It's encouraging that both sides want something specific from this pause in fighting that has not been accomplished yet, whether it's resetting for Hamas troops, Hamas fighters, or whether it's hostages coming back to Israel amid growing pressure. It also signals to me who's pulling the strings here.
True.
There was just a story coming out saying that Saudi Arabia has approached Iran about providing support to them if they pull back their proxy fighters in Hezbollah and Hamas, highlighting Saudi Arabia's desire and Qatar's desire and the United Arab Emirates to have stability in the Middle East and how far they're going to go to try to negotiate that going forward.
And a real awareness of the source of the instability,
Correct.
so to speak, in the region as well. More on those developments around Secretary Blinken's visit throughout this morning on Bloomberg TV and radio. I want to pick up on a single name. General Motors, GM, in the pre-market looks a little something like this, up by more than 9%. We've got a boost to the dividend by 33%. We're announcing a $10 billion share buyback program. GM also reinstating 23 guidance with just a modest cut to income. We'll be catching up with the CEO, Mary Barra, at 9:30 Eastern Time, Tom, on Bloomberg TV and radio.
Without question, the interview of the day. This is a shock to 493 companies that are trying to figure out what to do, what the sea change is for next year. And it's a double barrel here of use of cash and also cost reduction. I'm really interested to see how the big banks swallow this kind of shock.
I said this earlier, Tom, and I think it's the right story to stick on. Is it a change in strategy or just execution? Are we really moving away
that's your
from
first
some of those
question there.
investments
There you go.
in tech, Lisa? Are we making that shift away from robo-taxis or just investing less in it?
Or just shifting tactically while they try to improve some of the technology behind it? It's a good question.
Or to compete, as Sam Stovall said, with Hyundai. I mean, to me, the unspoken here is the competitive nature of the non-EV. What's the thing called
hybrids? You thinking hybrids?
I don't know what I'm thinking. I just think it's a hugely competitive
Well,
industry.
robo-taxis is something else. But
Are they competing with Ford? I mean, just as one example.
I mean, trying to.
Yeah, they're trying.
And they're all struggling, competing with each other at the moment. How about this for an investment? Let's get to this story. Tech billionaire Mark Cuban selling his majority stake in the NBA's Dallas Mavericks to Miriam Adelson, the widow of casino magnate Sheldon Adelson, selling $2 billion of stock in Las Vegas Sands in order to complete the deal. The purchase puts the value of the team at $3.5 billion. What did Cuban pay for it? $285 million 23 years ago. Bramo, what an investment.
Honestly, all of the things that I've read about this is, you know you've reached the top when Mark Cuban gets out. Is he just basically seeing the peak in terms of some of these professional teams and their valuations?
Tim McMahon at ESPN writes it up. It's a 57% Adelson holding. Second sentence of the article. Cuban stays in charge of basketball
Yeah, it's
operations.
interesting, isn't it? Yeah.
Small detail. He's not giving it up. I mean, it's. But again, John, to your idea here, the value here. Why are people stupid about sports franchises? Because down the road there's a payout.
He's given up Shark Tank. Just in case you've watched Shark Tank, Tom.
I can honestly say
16th season coming up, Bramo.
I used to watch it with my kids. I think that it created some monsters.
You're big on Shark Tank? We call it Dragon's Den in the UK.
Really?
Dragon's Den, yeah.
Oh, do they?
It's called Dragon's Den. You guys call it Shark Tank.
Or
I say we call it Shark Tank. Yes, I've been here long enough.
Remember
We
that.
call it-
Yes, come
They
on.
call it Dragon's Den.
All right.
Does that help?
Let's go.
He's never been on Shark Tank, but he's agreed to appear with us. Terry Weissman joins us right now, global FX interest rate strategist, much more than that at Macquarie, with lots and lots of experience on this. I love the first sentence of your note, don't believe the hype. You've been skeptical. Are you combining and dovetailing in with your low rate call a true slowdown in the economy?
Yes, absolutely. I think the narrative these days from Wall Street that I've seen in the last few weeks is that the reason that the 10-year yield has been coming down is because we're in a disinflationary phase here in the economy, and there's going to be more disinflation to come in the U.S. I agree with that. We are going to see disinflation in the U.S. It's going to come in rents. It's going to come in those areas of the CPI that are linked to consumer discretionary spending. But let's also keep in mind, one of the reasons we're going to see this disinflation is because the consumer is slowing. And there you have the don't believe the hype story, right? I don't believe the stories about record-breaking Black Friday sales and Cyber Monday sales.
Starts Wednesday, Thursday, whatever.
I think these sales were on the back of heavy discounting. If you look at what some of these corporate execs had said prior to the start of the holiday spending season, they talked about having to cut prices. Walmart even talked about deflation. So this is about disinflation, but let's keep in mind where this disinflation is going to come from. It's going to come from a weakening in pricing power at the consumer product and services level. It's going to be driven by a slowdown in aggregate demand in the U.S.
Also about how they're paying for this stuff. Buy now, pay later. You look at some of the numbers just booming. What do you take away from that?
So my takeaway is from a macroeconomic perspective, what it does is it shifts spending to the early part of the season, because normally you would have to save up a few more shekels as you approach, your deadline on December 25th to get those purchases done. With buy now, pay later, you don't need to do that. So it allows you to spend earlier, especially if you don't have access to revolving credit or credit cards. So I think that's another reason why we might have seen these so-called record-breaking days on last Friday and Monday. But again, if it's the case that spending was only pulled forward, it doesn't mean that in aggregate for the whole of the season we're going to get that much hype.
So far, people have viewed weaker U.S. data as a positive. It's both been for a bond rally and a stock rally, and you're saying that we could see that bond rally continue quite significantly going forward. Will there be a divergence, though, in terms of risk assets? Does there have to be to fuel a bond rally that goes much deeper than where we are now?
Absolutely. To let the bond rally extend to, say, where the 10-year yield gets to 3%, I do think it has to be associated with a sell-off at risk assets. I don't think, to get that kind of forceful move early in the bond market, you need to have some sort of dislocation in risk assets, some sort of drop in stocks. But over time, not necessarily. I think we can see a situation where if disinflation continues slowly, you get the bond yield going down to where it was, let's say, in the spring. 3.5% is not inconceivable without a stock market drop, as long as it happens slowly and steadily.
But will corporations adapt? If I go back to Bear Stearns, where you held court, you had an entire security analysis team looking at these slowdowns. I don't buy the gloom in that corporations like General Motors will adapt.
I'm not sure what they're going to adapt to. Technological progress and changes they can adapt to. Government policies that spur more investment in electric vehicles and clean energy technologies, they can adapt to. But what do you do when you have excess inventory, as the auto dealers do now? What do you do when the banks and the finance companies are cutting off credit to auto buyers? What do you do then? You're not in control of that situation. You're in control of what's happening on your factory floor. You're in control of promotions, and maybe the way you adapt is by cutting prices. Let's face it. That's a way of adapting too, to hold on to market share in the face of excess inventories, in the face of consumers slowing their demand. So yeah, they can adapt, but it's not necessarily in a way that is going to make their stock prices shoot up
You've identified a series of places in this economy where we could see lower prices. Retail, Walmart. Talked about the automakers. We're talking about GM, maybe lower prices. Going to see that come through the pipeline soon. What's the biggest threat that still lingers for you? The biggest threat to that view that this disinflation continues through next year?
It's supply shocks. I think the lesson of 2022 and early 2023 was that we cannot control what happens in the rest of the world, especially as it pertains to the supply of oil, the supply of natural gas. So from my perspective, if we get another shock in that market, and by the way, it doesn't have to be because of a war, although in the past 2 years that has been the case. It could be simply that OPEC Plus decides to curtail supply, and we get a Brent going back up to the low 90s as a result of that. Again, it's a question of how much they curtail supply by, but that's the biggest risk right now. The good news is that gasoline prices in the U.S. have been falling for 6 weeks straight, I think, and steadily. I think that's going to show up in the CPI by the time we roll around to seeing the November numbers and the December numbers. But the real reason that the CPI is going to still see disinflation is because rents in the new tenant market and the new lease market are coming down. That's going to put a lot of pressure ultimately on the BLS's measures of rents of primary residences. We're going to get that disinflation over the next few months.
This is exactly what Neil Datta of Renaissance Macro is talking about, Tom. The disinflation that's in the pipeline for rents, for used cars, which is why, based on what Wallace said yesterday, it's not that much of an if for the likes of Terry, for the likes of Neil Datta, which is why they think you're going to get this conversation early next year about reducing interest rates.
Yeah, there's no question there's a school of thought out there that this is not if, it's just simply when and the path to it. But I would dovetail it back to the labor economy, which we've barely touched on today. And we've got claims coming up here Thursday. And then you mentioned the late jobs report for November. I believe it's December 8th. But the basic idea here, John, is when does a labor economy finally go? If you get a labor economy to go, you get there instantly.
Claims 209. Keep going back to 209.
Claims 280.
We've been surprised by this economy in so many different ways over the last 18 months or so. Terry, it's good to see you. Terry Wiseman there of Macquarie. If you are just joining us, welcome to the program. The state of play, the scores look like this on the equity market. The S&P 500 positive by 0.4%. Yields are lower by 3 basis points. Your 10-year 4.2879. The dollar stronger this morning, but it's dollar weakness this month, Lisa, which catches most people's eyes.
Especially given this ongoing feeling of disinflation. Terry Wiseman mentioned something there, that gasoline prices in the U.S. have been steadily falling for 6 weeks, almost 2 months now. They are currently at the lowest level, average gasoline prices, since January 2nd, just to give you a sense of how far they've fallen. Is this part of what's underpinning some of the disinflation that people feel more extremely? I mean, again, these sort of questions around, have we seen the peak, a complacency around, there isn't going to be another shock due to geopolitics? I don't know. This, to me, is kind of a sort of sleeper issue.
Well, we got the supply shock.
Exactly.
At least we thought we did. And then it didn't happen. Crude ends September, Tom, in 90-something, in the 90s, back down to 77. We had a drop of more than 10% in October, and a drop again in November.
And the Bloomberg Commodity Index, even with, orange juice and cocoa and all that taking off, I mean, the bottom line is there's a disinflation there of some form, and, linked into China. I mean, I get that.
I know you've been looking forward to this conversation all morning, Tom. In just a moment, Doug Cass of Seabreeze Partners on the life and on the legacy of the late Charlie Munger. TK, that conversation 5 minutes away.
Can't wait for it. And to follow on to that with Howard Marks. Terry Weissman, Doug Cass, and Howard Marks. That's what surveillance is about.
Back to back on Bloomberg Surveillance, live on TV and radio over the next 30 minutes or so. From New York City this morning, your equity market positive by 0.4%. Good morning.
What do you worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
nature of good enterprises, that they know how to accept change, even a sudden unexpected change, and go on quite creditably. And that's exactly what will happen at Berkshire.
The former Berkshire Hathaway vice chairman, Charlie Munger, speaking to Bloomberg back in 2011. Charlie Munger died yesterday at the age of 99. TK, ever since yesterday afternoon, around the market close actually, the tributes just started to flow in.
Yeah, it reminds me of John Templeton's passing and the great Phil Correa at Pioneer as well. We are thrilled to bring you Howard Marks. He'll be coming up. He specifically wants to talk about Mr. Munger. And right now, and this, I can't say what an honor this is. 10 years ago, he was a designated piñata. Doug Cass was the ultimate short panelist at the meeting of Berkshire Hathaway and lit up the investment world with a sharp conversation. Thrilled that he could join us today from Florida. Doug, what did Charlie Munger mean for Warren Buffett?
That's a great question, but first let me say, Bramo, John, and Thomas, or as we call you in our household, Tinkers to Evers to Chance. It's great to be honoring Charlie, and Tom can explain the Chicago Cubs double play. You know, this was a beautiful friendship, an exquisite love story, far more complicated than Ryan O'Neal and Ally McGraw in the movie of the same name. It was a 6-decade in the making of two great friends and a melding of two great friends and investment minds, arguably two of the greatest investors of all time. He was a compendium of reason and value, and to many of us value investors, like my friend Howard Marks is coming up, we worshiped at his altar. Warren Buffett held his tongue a lot, but Charlie could be prickly and almost defiant. They were both very blunt and both very brilliant. I think that Charlie was far more, in terms of cerebellum, intelligent than Warren. He graduated Caltech and had a law degree from Harvard. He considered himself the smartest man in the room, and guess what? He was. He didn't suffer fools lightly. He had no patience for idiots and told those people they were idiots. In terms of the question I think you're leading to, what are the consequences for Berkshire Hathaway? There already has been a line of succession established, and Charlie Munger inadvertently mentioned it in the Berkshire annual meeting in 2021 when he said that Greg Abel would become the chief executive. Warren Buffett is no longer in charge. Doug, but this is a big personal loss to Warren. Sure. He's lost his confidant. He's lost his best friend. Charlie, long ago, embedded the idea, this is the most important thing that he gave to Warren. He embedded the idea of quality and concentration with Charlie, preferring to buy a wonderful company at a fair price over a poor company at an attractive price. Remember that Warren initially bought broken companies, or cigar butts, as he called them, in the early days. But he changed with Charlie on the scene.
Right. I want to get this in, Doug Cass. I think it's so important. When you were at Kidder Peabody down the hall from Julian Robertson, you and I would wait for the annual report of these two guys. Explain to our younger audience worldwide what was so special about that Berkshire Hathaway simple printed annual report. The only proxy I have now is Jamie Dimon's note.
My annual reports are dog-eared. I've literally read each one over 50 times, and I'm not being hyperbolic. The value in them was the wit and the sayings, and Charlie had some of the best sayings. One of those was, if I can be optimistic when I'm nearly dead, certainly you can accept a little inflation. Or to say derivative accounting is a sewer is an insult to sewerage. Or as you tweeted out, every time you hear EBITDA, just substitute it with BS earnings.
You know, I look at this, Doug Cass, and let's go back 10 years. You were the piñata, you were the short seller, the gloomy guy at the meeting. When you and Munger battled at that 2013 meeting, how many hits did you take?
I took a bad hit in my most important question. You know, Warren wanted to do something different. Never in the history of annual meetings has a short seller who short the company's stock been invited to ask hard-hitting and hopefully respectful and tactful questions. So I sat in the dais next to them, and the question I asked is, would you consider giving a couple $100 million to me to manage a short portfolio? And that if after 2 years I failed to outperform Berkshire's portfolio, I would return the investment fees back to Berkshire. Well, his response to me was pure Charlie Munger. He said with regard to his unwillingness to sell short stocks that he doesn't like trading agony for money. It's just brilliant.
Do you notice that Cass is cut and chiseled? I mean, he's not been out on the golf course.
He has told me a few times he's on Ozempic, 50 pounds
it's
lighter.
It's like a new Doug Cass that we're seeing.
We can
here.
perhaps get into that in just a moment.
Yeah.
Doug, I just want to explore investing approach just a little further with you. You referenced that quote, and I'll share it again. Far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Charlie understood this early. I was a slow learner. Doug, can you talk about the evolution of their approach to markets, particularly in the last, say, decade or so, given the explosive nature of indexing and just buying the S&P 500? How have things changed for them, Doug?
That's a great question, and it's an essay answer, but I'll try to be brief. He used to try to buy gazelles, John, that were in trouble, whether it was American Express in the oil scandal or Geico was on its deathbed and trading at $1 a share. Because of Charlie, he started buying companies like Chicago Pneumatic and Lubrizol, Heinz, quality companies. He would pay up for those companies. I wrote and discussed in one of my questions, he was searching for gazelles in the old days, but he was buying at hefty prices consumer product companies that he was comfortable with. I think he was protecting Berkshire Hathaway and making them morph into something that resembled an S&P index fund. And I think that was his legacy, Jonathan. Impenetrable moats, impenetrable suite of products and companies.
Doug, it's fantastic to get your thoughts this morning. We all do appreciate it. TK referenced, of course, Ozempic. I think maybe we can finish on that. Doug, we were talking about how life-changing that might be for this economy, to approaches to markets. Can you speak to that personally, Doug? Just have you changed your investments off the back of your personal experience with this?
I do own Lilly. And I have said that for now, AI is an elegant parlor game, and that Ozempic will have, in the next 3 to 5 years, a much more profound impact upon our economy than AI.
Any thoughts on where you think that impact will be most profound, Doug?
Lower insurance costs, most importantly, I would say.
Doug Cass.
And I think this is one area where you can get partisanship in Washington, D.C.
Interesting.
He says that with a smile at the end there,
He
TK.
did. He did.
I think we can agree on that. Hey, Doug, fantastic to get your thoughts on the legacy of the late Charlie Munger. Doug, thank you. Doug Cass there of Seabreeze Partners. That approach to markets, Tom, had to change. Had to change because the way everyone approached markets had to change.
It has in the time of the Magnificent Seven. I mean, it's been a shock. Doug's been an Apple bull for years within his short selling in the times he's been off. And, you know, as any short seller here, you see Jim Chanos shutting down. It's been a sporting 2023 for that crew. But what's timeless here and what's sobering into 2024 is the idea of what do you do with quality when it's so narrow. That, to me, is fascinating.
And understanding what quality is. I mean, you think about Warren Buffett's first company and his adjustment to this sort of buy a wonderful company at a fair price. It was See's Candies, right? It was something that he liked the candy, and he paid a price for it that he wouldn't previously have paid, and it delivered him $2 billion in profits over the tenure of his experience. It isn't tech. It isn't Ozempic. It was See's Candies. I think that that's really interesting. How has that changed with different, you know, trends, et cetera? But that, to me, is interesting.
As the great Peter Lynch would say, I was so honored that Peter Lynch joined me the day of John Templeton's death. If you have to explain what it is, that's a bad start. You know, I'm sorry, Apple, they sell phones. That's, I think, what they do.
One thing has changed, though, in a big way, and Doug alluded to it just there. The benefits of being that concentrated pool of capital that you can dial on in an emergency, 1-800-Berkshire. Saw that in the financial crisis. The Federal Reserve response time to the pandemic kind of changed the game a bit, Bram, on that front, didn't it?
They took the front seat on that front. They didn't need to go to Warren Buffett to get his cash.
All that cash was there on the sidelines, and that window was like this big, last a few months. Coming up on the Open next hour on Bloomberg TV, Richard Bernstein Advisors, Bob Dollar, Crossmark, Sarah Hunt of Alpine Saxon Woods, and the GM CEO, Mary Barra.
Let's suppose you're on a plane and somebody realizes who you are. They say, I have $100,000. I don't know what to do with it. Where should I invest it? Where should they put their money?
So today, it's a easier decision than it was maybe 2 years ago because Treasury bills are 5%. So I would say, regardless of how much risk you want to take, you have to put a portion there. Then you would have to ask, really, an individual is the same, I think, as any institution. What is your time frame? Do you need to get access to this $100,000 in the next few weeks, the next few months, the next few years, not until you retire? And that will determine your investment decision.
So what do you think is the most common mistake investors make when they have 100,000, $1 million, or whatever they might have? What is the most common mistake you have observed that investors make?
I would say hubris and thinking you know more than you do, because every decision that you make has many, many layers. So as you're creating a portfolio, look at the risk as well, not just excited about the return.
And what's the best investment advice anybody's ever given to you?
Continue to learn about innovation in whatever you do, because that is where it's not exciting, that's where returns will go.
On the next episode of the Business Week Show, imagination.
If no one else is going to buy and protect these buildings and make sure that people on the South Side have opportunity, is there something that I could do to try to acquire some of these buildings on my block?
You know, I feel really bad for young artists. They get swallowed up, spit out like stocks on the stock exchange.
Watch the Business Week Show Thursday nights, 10:30 Eastern on Bloomberg Television, or 8:30 on Bloomberg.com or the Bloomberg app on connected TVs.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Central banks are going to cut regardless of kind of the setup for next year.
We'd expect to see something like 150 basis points of cuts from the Fed next year.
There is a potential for the Fed to make it all the way to the fourth quarter of next year without having a cut.
It's very hard for them to look forward 6-9 months and feel confident that inflation is going to be at their targeted level.
People are very quick to think that things are over when they take time to actually get through the system.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Markets up, yields down. Really an extraordinary day. Lisa and I will dive into that. John Farrow on sabbatical here for the next 60 minutes. But what we've got is markets on the move, and also, of course, the death of Charlie Munger. What a joy to have Doug Cass with us here moments ago. Howard Marks coming up momentarily. Mr. Marks, on the life of Charlie Munger, the impact he had on all of us, including Oaktree and the rest. Let us turn to the markets right now, and what I would say in the last hour, maybe off the GM bombshell, a furtherance of the good feeling that started yesterday.
And how much is this also piggybacking on the concept of disinflation? This just crossing the German preliminary CPI coming out below expectations at 2.3% versus the expectation for inflation coming in annualized at 2.5%. This is part of what's driving the good feeling. Disinflation without a disproportionate amount of pain. Is it just sort of the illusion of a soft landing before something else? Or is this exactly what people had been expecting? And that, I think, is really one of the big questions heading into next year.
We'll do the data check here in a moment, but Russell 2000 on a November basis breaking out to up 1%, showing the good feeling. SPX up 0.5%. And what it comes down to is a Waller shift. We've talked about that through the morning, but much more for me is the Barra shift. John's going to be speaking with Mari Barra in the 9 o'clock hour, and I'm sorry, this is not a mundane press release from GM today.
Talking about some cost cuts as well as dividends and share buybacks. There is a question here about how difficult it is to parse through a market and understand valuations at a time of industries very much in flux. I think about with the auto industry, I think about that with the tech industry, and then I think about it with small businesses, mom and pop shops that are trying to compete with inflation and benchmark costs. This is the reason why I think it's actually really important for us to be talking about Charlie Munger, who lived through a couple of sea changes in the concepts of investing and how to value companies and what it means to have a wonderful company and what it means to have fair value.
And what's important about this, we'll talk to Mr. Marks about it, I'll frame it then, folks, is that Charlie Munger, to me, was formed off of double-digit losses in the 73-74 bloodbath. It was really ugly, and that steeled him for the fundamental analysis he did into the future. I haven't asked you this in ages, and it's germane to where we are right now. The 10-year yield, 4.29%, a little bit lower earlier. 5-year crescendos down to, 2-year rather, crescendos down to 4.67%. Futures up 22. The VIX is stunning, sub 13. What does the spread market signal? I mean, you know, Howard Marks has got 4 Bloomberg. Howard Marks has 20 Bloomberg screens in his study. And he's got them all distressed out. What does the spread market say, oh wise one?
Well, I know that Howard Marks probably looks at the balance sheets more closely than public market marks. There is a question we can ask him himself, but really, to me, the question is whether we are seeing complacency bleed into public markets. Private markets, a different story, but public markets, a lot of people talking about how they really are not reacting to the slowdown in consumers, in the likelihood of a higher for longer type of regime, and they're just pricing in the Goldilocks that equities are.
Well, the Goldilocks maybe that 7 stocks are is, well, we're going to wander through a group data check here right now. Can you give me General Motors, Amy, when you can? General Motors with a big pop here off what we've seen with futures up 22, the 10-year yield 4.29%, oil up maybe $1 or all. Watching gold, I mentioned Dennis Gartman yesterday, gold in yen, one of the great trades of the generation. It's to the moon. It's a moonshot up with gold well over 2,000. And General Motors up 8% as well. Every CFO of the 493 lost stocks have to review this strategy this morning.
And where they're going to cut costs and how they can invest to compete, not least of which with China.
Yeah, it's going to be interesting to see. I think of days as to the death of John Templeton and what surveillance did, and we do this today with Charlie Munger. We had Terry Weissman on. Great to have Sam Stovall on, and Doug Cass with his intimate relationship with Berkshire Hathaway. We finished strong with Howard Marks, chairman of Oaktree Capital Management, and I must point out, author of not 1, 2, but 3 important books on investing, of what to do, and just as importantly, Howard, what not to do. Howard, on Charlie Munger, getting the odds on your side, how did Charlie Munger get the odds on his side?
He started off with a brilliant mind and a brilliant partner. He intensively studied the financials, thinking about the long term. He never tried to guess what a company or a stock would do in the short term, and he held for many years. You know, he was a great practitioner of sit on your hands, and he did it flawlessly.
In the modern day and the modern media, I remember reading those annual reports, Howard, years ago. There was no financial media. There was no blogging internet. The short-termism we're living it now. What is the lesson of Charlie Munger's long-termism?
Well, if you want to hit the long ball, you have to be very patient. And when a stock moves up the first 20%, you can't start taking profits. Charlie and Warren have held things for decades, and the other thing is they were just, and Charlie always talked about this. You have very few moonshots. Charlie said within the last year that most of his wealth came from 4 decisions. And so, what would have happened if he would have started trimming those 4 decisions early? He certainly would not have accomplished what he did. And I think Warren would say the same thing. Maybe the number 4 would be a little different with Warren. But, Warren's famous for having said, put all your eggs in one basket. And I watched the basket really closely. And I think that it wasn't one basket, but the idea of concentration and patience coupled with good decisions makes for a great success. A concentration and patience don't accomplish anything if you can't make above average investment decisions. But putting it all together is the formula for success.
Howard, you wrote in some of your thoughts about Charlie Munger that he had very definite opinions, in particular regarding the investment management industry. He viewed the industry with considerable skepticism, and while a member of it, I found myself in agreement with him more often than not. What exactly are you talking about in particular?
I think both Charlie and Warren felt that our industry, relatively few members of it, made substantial contributions to their clients' wealth. Many more members were well paid. He was always one who questioned incentives. He says, "You give me an incentive, I'll tell you the behavior." And I think that I think that Warren and Charlie viewed their operation. In fact, Warren said in quotes, "Not a partnership, not a corporation of partnership," and they considered the people they manage money for, their shareholders, to be their partners, and they considered themselves to be working for their partners and not themselves. And their own wealth and success was a byproduct of doing great work for the partners. So, I like to put myself in the same boat. Those sentiments appeal to me greatly, and I've tried to follow that.
How difficult has it been to adapt the strategy to different eras? When you had conversations with Charlie Munger, there were questions around tech and how that changed the investment thesis. How did they think about the changing concept of what a wonderful company looked like and what fair value was?
On the one hand, you have to evolve with the times. On the other hand, they never went full bore into the tech sector. They're famous for having made a lot of money with Apple, but most tech, the way they said it, they put it on the too hard pile. And if you understand that your success will come from a small number of holdings, but that means you don't need 20, 30, 40, 50, 60. You don't need to exploit all the sectors. You just have to find a few great ones. Of course, on the other hand, Tom said that we're in a new era with all the communications we have. Part of what that means is that the world is a more interconnected, intelligent place. Back 50 years ago, we used to be able to exploit things nobody else knew. Today, there's very little information that doesn't make its way speedily around the world.
Howard, help us with one final question here to the future management of Berkshire Hathaway. They have from COVID buildup of cash of $412 billion out to $500 billion, $525 trillion. You and everybody else out there is living with explosive money market fund growth. You know the story in that. Forward here for Berkshire Hathaway, what's the best use of their and our mounds of cash?
You know, the people who run Berkshire today and will run it tomorrow understand the limitations of size. All things being equal, size makes it harder to outperform. They have the best probability of outperforming of any company their size, but their size will matter. And, you know, one of my professors at University of Chicago, I asked him afterwards, how would you manage a big fund? He'd say, I would index the core and manage the hell out of the periphery. And I would imagine that at their size, they'll have to move in the direction of something like that, although they will not give up on outperformance.
Howard Marks, thank you, with Oak Tree Capital Management in remembrance of Charlie Munger. You know,
Lisa, thank you for having me on at this important moment.
Thank you so much, Howard.
Mr. Marks, thank you so much. And I look, Lisa, here at all of this, and it reminds me of the death of John Templeton when Abby Joseph Cohen and Peter Lynch and others stepped up. And the common theme here is the short-termism of financial media that you, I, and John and Paul Sweeney have fought for years. There's got to be a long-term perspective, particularly when you look at the failure of the American retirement system. Yeah, and it's going to be interesting to see. Quickly here, we got to look at the data here. Standard & Poor's 500 up 0.5%.
When you talk about the short-termism, I wonder if Charlie Munger were growing up in today's market, if private markets would have a very different kind of environment than public markets, simply because of the indexing, of the difficulty to value in real time.
Howard alluded to that, and I strongly agree. The methodologies, the hagiography we do of what used to be is not replicable today. It's a different world here today. I mean, it's just as basic as, does the market close at 4 or does it close at 12 noon because we all have cell phones now? It's a whole, I mean, even the daily rhythm of the market has changed, let alone fundamental investment.
One thing that Howard Marks said that I thought was really important was the idea of size, and how size has shifted a lot of different investment firms, and how at a certain point you have to be the index, if you are the index in your size, and then you just have a slice where you try to make not necessarily moonshots, but really good bets. And that seems to be what we keep hearing, and it raises a question of whether the outperformance might be in the smaller funds, but they can't necessarily amass the critical.
You know, Pharaoh, as a joke, keeps a clock on Apple earnings when I explode about the lousy reporting on it. When you get to that size, you manage for profit. You don't manage for revenue growth because it doesn't move the needle. Right. You manage for profit, which is what we see with certain selected companies, including in Cupertino. Thanks to our team. This has been fabulous on Charlie Munger. Good morning.
Daybreak Europe, I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
DOJ or other authorities
could face big
bigger challenge was next.
Fed was going to keep rating World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
I think any part of the business can be made more efficient. Even in the areas when you're growing, you can still look at how do I grow efficiently. One of the things I always tell the team is, I want you to be scrappy. Pretend it's your own money and it's your last dollar. How are you going to spend it? And getting that kind of creativity, I think that's when people do their best work.
The engineer, the chief executive officer of General Motors, Mary Barra, this is going to be important. Please stay with us on Bloomberg Television and radio in the 9 o'clock hour. What do you think, Lisa, here, like within the hour? Maybe 55 minutes. Pharaoh's in charge of that clock. Mary Barra.
9:30 at the market open. We'll see.
Grilled by John Farrell. Grilled, I say, by John Farrell. Mary Barra, that's an important conversation coming up. Right now, we get a pre-brief with someone qualified. David Welch is Detroit bureau chief. He knows it is the Detroit International Auto Show, and he joins us this morning. To me, it was the set of announcements. David, let us start with the cost cutting. Can you do use of cash because you're going to pare the budget to the bone at General Motors?
In a way, they're forced to do a lot of cost cuts because the new labor contract is going to cost them an additional $9 billion over the 4 years and 8 months of the contracts. They've got to find other places to cut if they're going to keep profits going, because their plans to double revenue by 2030 to $280 billion. They're actually growing revenue this year. I reported a week ago they're on pace for a 12% gain in revenue despite the strike. But all this new market share from EVs and from autonomous vehicle ride-hailing sales with the troubles of having a cruise, a lot of these technology plans are kind of stuck in second gear. So they've got to find a way to boost profits, and cutting costs and maybe selling some more expensive internal combustion vehicles is the way they're going to do it.
Is this pressure from the CEO, Mr. Farrell will speak to her in the hour, or is this the board pressure, or is it outside visible or less visible activist pressure?
We don't know if there's an activist in there. I think, well, so far no one stepped up. I think the threat of that is there. I think the board's aware of that. Look, the share price is down 12%, 14% this year. It's lower than when Mary Barra took over. It's lower than the IPO of 2011. None of that is good. Now, look, the street doesn't really like legacy auto companies. They haven't really given any of them much love because they see this internal combustion business as a long-term decline, and none of them have been able to successfully sell electric vehicles to show that they can stay in the game. So companies or investors are sort of ignoring these companies. So GM does generate a lot of cash. That's the one thing they do very well. Under Mary Barra, they've had record profits, record cash flow. So their way of luring investors in is by returning some of that to the market.
David, can I just parse through some of what you just said? There's a question of what the connection is to now versus, say, 3 months ago. How much is GM trying to piggyback off the new contract with workers and say, look, if we've got higher costs, we have to cut elsewhere, we have to become more efficient? How much is that part of the narrative?
It's a lot of it because, look, among the various things that were weighing on the stock over the past year, the labor contract is certainly one of them. Even before the strike got ugly, the rhetoric got nasty, the market knew that it was going to be an expensive deal because the last couple of labor contracts were relatively cheap for all of the car companies. And with record sales, record profits over the past few years, the union was really kind of sharpening the knives and saying they were going to go to the mats on this, and they did. So a lot of that was built in. And inside GM, there's a lot of talk about having to do things more efficiently, find new ways to engineer and build vehicles that reduces fixed costs because their variable costs, namely labor, has gone up significantly.
David, how much is this an excuse for the larger picture that you're talking about, which is namely competition from China? We've heard this very directly from some of the European car makers. How much is that really the main overhang that's leading some of these companies to say, let's monetize what we've got? Yes, maybe some of the combustible engines are not going to be for the long term, but right now, we're not competing with the likes of some of what's coming out of China, out of Korea, out of Japan.
It's a really tough time right now to be running any of these old car companies because you've got Tesla, stealing the luxury market and being the real growth company. You've got this threat of companies from China coming, so I think you're right. That's a very big piece of it. And then meanwhile, they've got higher costs, and they're struggling to get out of the starting blocks with their own electric vehicles. Really, other than generating cash, a lot of what's going on with these companies just isn't really working right now. So this is the one thing they can do to keep investors happy, and I think their board's aware of that.
David, I saw an inventory chart. I was shocked at the Stellantis inventory. Speaking as an amateur, you're the pro here. Tell us about inventories into the brutal winter months. Is it going to be everything on sale?
We haven't seen that yet, but I think as interest rates really have kind of eaten into consumer confidence and also just raised the monthly payments for vehicles, which were already really high. It's already well over $700 a month is the payment for a new vehicle. I think you're going to have to see some incentives come in to offset the interest rate effect, just for starters. And look, interest rates have an impact on the economy, right, Tom? I mean, they slow activity down. It's economics 101, and it's what the Fed wants to see happen so they can bring prices down. Vehicle prices are still at historically high levels, even though they've come down a bit.
David Welch is a pro, goes right to the heart of it. $700 a month. David Welch is shopping new cars in Detroit for Bloomberg, driving all of our coverage. They are a bombshell. Mari Barra coming up. Again, I can't say enough about this. John Farrow in conversation with the engineer from the General Motors Institute, the chief executive officer of the General Motors Corporation. The legacy of this, I can't say enough, Lisa, about the legacy of this that David touched upon, and there was the key phrase: Wall Street has ignored the auto companies. I find this, and this is Tesla an auto company or not? I don't want to get in that debate right now. But the base, I think of Ite, my colleague, and I mentioned him earlier, the Uber bull on GM. He's been right about market share this, pickup trucks that, but has the stock been there? And the answer is no.
And we've seen this since really 2009, right after that became a real focal point of the bailout and all that. I will say this, one of the questions that I have is how much are some of the auto manufacturers in the U.S. ratcheting back expectations because of auto loan rates and the increasing delinquencies. Just want to point this out from the latest data from the New York Fed showing that the average rejection rate for auto loans reached 11% in the latest read. That is the highest in a series going back to 2013.
And you still, it's what does it cost to get into? And we're all hardwired for $2-something a month, $300 a month, unless you're driving something fancy. But, you know, they price themselves out of the American market. It comes into used cars, and even in used cars, with the slowdown, you have true disinflation in the price of used cars. And to the inventory chart, I don't have it in front of me, folks, but it's real simple. I guess Ford and GM doing better than Stellantis, Chrysler. I still can't get used to the word Stellantis, Dodge Ram, and that kind of thing. And then there's others as well. And it just seems to be, as a general statement into the winter, a lot of cars out there.
Especially as you see delinquencies, in particular younger borrowers who are borrowing to buy cars, really creep up to before what we saw during the pandemic. I mean, this is actually exceeding that by a significant margin. So again, I mean, do we start to see the disinflation there, or do they just reduce production enough that you end up with sticky prices despite just lower volumes?
On a Tuesday, near the end of the month, I will say for the first time, folks, what I haven't said in ages. Bloomberg surveillance is on a record high watch for the NASDAQ 100. Russell 2000 up 1.1%, NASDAQ 100 futures 16,155, which is below that 16,573 record high, but now we're within reach.
And fueled, I would say, in significant part by the rally that we've seen in the bond market with the expectation of rate cuts. I will just say this, coming out from Andrew Hollenhorst of Citigroup moments ago, pushing back a little bit against sort of the rate cutting enthusiasm that we've seen, saying, we continue to think these, quote, normalization cuts are more a theoretical possibility than a likely outcome. The Fed is likely to wait until the economy is more clearly entering recession before cutting rates. And it goes to this question of what's the threshold to actually make that move. We're going to be listening for that from some of the market speakers, from some of the Fed speakers ahead of the quiet period.
Second look, third quarter GDP with a 5% statistic on it. Interesting to see the makeup of that, the GDP price index. And then, you know, claims on the 30th of the month, 2 days, tomorrow rather, claims coming out here will be extraordinary. I mean, continuing claims and also initial jobless claims, 218,000. I think that used to be called fully employed America is where I would put that. Stay with us. Much more coming up on the American economy. Laura Ron, FS Investments.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite. Surveillance. Good morning to all of you on radio, on television, worldwide. Radio CarPlay. Do you have CarPlay?
I'm going to get it. I'm going to try to adapt to the modern era. Do you have CarPlay? Do you have a car?
No, do I? No, the driver has one. You know, he puts a button, opens a window, and says, "Would you like your CarPlay, Mr. Keenan?" You know. I say yes.
Cigar.
Carol Master in the afternoon. You know, it works out. Good morning to all of you. We have economic data. We're going to get to it in a minute, but some eventful work yesterday. Bond market driving equities higher up 23 points. Lisa, please.
Well, just want to point this out. Right now, Fed swap contracts are pricing in a full 0.25 point rate cut by May, and you've seen that in yields that keep coming in, 4.2859 now on the 10-year. So as you had these bets on Fed rate cuts for next year, Fed Governor Chris Waller telling an event in Washington yesterday that he's encouraged by the recent economic activity.
I am increasingly confident that policy is currently well positioned to slow the economy and get inflation back to 2%.
Meanwhile, fellow Governor Michelle Bowman leaving the door open for further rate hikes at a speech in Salt Lake City. Maybe nobody listening, but this is what she said, quote, "I remain willing to support raising the federal funds rate at a future meeting should the incoming data indicate that progress on inflation has stalled or is insufficient to bring inflation down to 2% in a timely way." This ahead of 2 p.m. today, the Fed Beige Book release. That's going to be coming out. And Fed Chair Jay Powell speaking in Atlanta tomorrow. I do think it's interesting that people were listening to Michelle Bowman and like, yeah. Basically, that's what you got to say at this point to create at least a vision that there's some options here. Bloomberg's Michael McKee joining us. What did you make of that? The fact that markets really keyed in with Chris Waller and completely ignored Michelle Bowman.
It's because Michelle Bowman was suggesting what they want to hear, that we might not need to see additional rate increases. Chris Waller getting some support from the GDP numbers just out this morning.
Am I right? Shocking?
Shocking, yeah, in a way. Third quarter GDP revised up to 5.2% from 4.9%. That's well above the 5% that was thought. And a lot of that comes from increased business investment, which came in pretty low in the initial report. And so that was a bit of a surprise, but we're seeing a little bit more non-fixed, non-residential investment. The GDP in terms of personal consumption, however, is lower. We spent less, 3.6% compared to 4%. Lisa's refrigerator will show up in the fourth quarter, I think.
Yeah, this is true.
And the GDP price indexes, which the Fed doesn't really pay attention to because they're quarterly averages, come in lower than anticipated. The quarter-over-quarter PCE price index, the core, comes in at 2.3% compared to 2.4%. Now, we'll look tomorrow to the PCE numbers to see whether we get the same sort of thing. Trade deficit widens. The advanced good trade balance for October, $89.8 billion from $86.9 billion. So that's a little bit of a subtraction off of the first month of the fourth quarter. And then inventories come in weaker, down 0.2% on the wholesale level and flat on the retail level. That is less than what had been anticipated. There's your roundup of Chris Waller.
Well, let me look at the market here with the lift here. The futures up were 22, now up 24, 0.5% on SPX futures. Dow up 133. The VIX gets love, 12.58, a lower quiescent VIX. Russell 2000 up 1.2%, shows the effect here. And Lisa would say, yeah, it's bonds in 4 basis points, 4.2827% here. Mike McKee, I got to go right to tomorrow's data before we go to Laura Rahm. And the basic idea here is no one's talking about the job market. What if we get another glorious jobless claims, say under 220? I mean, it confirms a fully employed America, right?
Well, it would probably mean for market participants that they're going to keep their bets right now that the Fed will start cutting rates by the mid part of next year. Nobody seems to be buying into the Bill Ackman argument yet of the first quarter. But it's a week from Friday that we really care about in terms of jobs, and it'll be interesting because we're in the quiet period then. And then we also get CPI just before the Fed meeting. So two of the biggest data releases come in the quiet period. We'll see if they support the Waller view that the economy is slowing enough to bring inflation down. That'll be the key thing. Tom, I would point out, I know you're a nominal kind of guy.
Yeah.
Nominal GDP for the third quarter, the second estimate, 8.9%.
That's.
I knew I'd make it.
You get me going on this. We're going to go to Laura Rahm. I was guessing 8.1%, and I figured you'd say 7.8%. Did you say 8.9%?
I said 8.9%.
Absolutely stunning. Michael McKee knows how to make me speechless. John Farrow would say, well, that's a good thing. Joining us now, Laura Rahm, Chief U.S. Economist at FS Investments, on an 8.9% nominal GDP America. Laura, what's so great about your economics is you've got it from a litmus paper of the FX market. How alone is the United States with an 8.9% nominal GDP when Rishi Sunak is telling Francine Lacroix he's worried about austerity?
I think we are still, the growth continues to just surprise to the upside. And to me, it's remarkable the inconsistency between talking about rate cuts to, this idea that we're going to need rate cuts in the near term to support the economy, or this short-term idea that we've seen the labor market slow, and really we do feel like we're an economy, and the data would show that we're an economy firing on all cylinders. Government, business spending, consumption. The only piece that's not really adding to it is residential construction. I would say that we are the standalone leader on growth.
And what's so important here, Lisa, on nominal GDP top line, that's real GDP plus inflation, is there's an assumption here by the Bill Ackmans of the world, economists and not, that it's going to plunge down to what, 6%, 5%. Even that's a boom economy.
And when you say it, they're talking the inflation component. And Laura, that's what I want you to weigh in on. How much does it matter if we see a slowdown? Do we need a slowdown if we continue to see the pace of disinflation that we've seen so far this year?
I think there's two pieces to that argument. To me, the real, and one place where I'm probably off consensus, is I am really reticent to think that we are going to get this magical slowdown in inflation back to that 2% lane that we have had. On the good side, we have a lot of indications that just from some slower demand and from some of these resolutions and inventory that we're going to see lower goods prices. But I think we are really ignoring the big elephant in the room, which is services. We still have a hot labor market by my measure. We still have wage pressure that is way higher than prior to the pandemic. And the resting heart rate of inflation is still well above 2%. And on the services side really is the problem here. So I think we need to be careful about being very complacent about inflation coming down. And that really feeds into this non-recessionary rate decline, Goldilocks complacency that has taken hold of equity markets at this moment.
In some ways, the Fed's Waller really kind of fed into that yesterday, which is the reason why maybe he gave steam to some of these market movements. He said there is just no reason to say you would keep rates really high and inflation is back at target. How high is the threshold then to cut rates? If we do see the disinflation in the pipeline significant, it might not be long lasting because of some of these other issues, but we do see year over year comps come in with auto price disinflation or outright deflation, with rents coming in, with the fact that goods, as Walmart said, just prices are actually going down outright.
I think the Fed is good at looking around the corner on especially this rent issue. There's no doubt that rent is a very lagging indicator, but it's sticky for a reason. And all of the short-term indicators that 6 months ago were really pointing to rents coming down fast have now reversed. And I think something that's very important to me is the fact that rents are far below the cost that it is to buy a home per square foot. It's costing you a lot less to rent. And landlords are rational. They're going to see this, and they are going to, over the next several quarters, push rents higher again. So it's something that you just can't ignore in the core, even if you get the headline hitting 2%. I get nervous when the Fed tries to micromanage the inflation process.
Laura, and this, with your overarching philosophy of summing all this together, are we beyond the pandemic? It sure doesn't feel like it to me. It feels like the stimulus is still popping. But from where you sit, are we beyond COVID?
Not in the data, Tom. I think we're seeing this trampoline effect, and the Q3 GDP numbers are a great example of that. And we had a big inventory, push higher. We could very well get that still detracting from the fourth quarter. You're still getting some of these big swings in factors that are disguising what's going on underneath with demand, which is still really red hot. So this is a big, to me, piece that we're looking at for 2024. We start to see some move away from reliance on savings towards income. I think the irony is it could be a period of lower growth next year, but actually better sentiment about household economics as you see income finally catch up to the prior year and a half of inflation.
Okay, I'm going to pin you down here. Give me some 2024 Laura outlook numbers. Real GDP, what do you think?
Real GDP 1.4. And I think the 10-year stays pretty high. I'm putting it at 4% for 2024.
I mean, these are, Lisa, these are huge slowdown numbers. And then the question comes over immediately, what does non-farm payrolls do? David Kelly at JP Morgan would say it goes negative.
Well, and this is really the ultimate question, Laura. Do we get that kind of slow growth but high yield along with a fully employed America, along with job creation that continues to chug along?
I think that we look at the recessions that we've had in the 2000s, 2010s, even the 1990s. We saw very little, if you look at 1990, 2000 recessions, we saw very little drop in output, but a massive decline in labor. In this, I think, upcoming year, we're going to see a slower economy, but I think that companies continue to view labor as a scarce resource. I think the true Goldilocks is not going to be defined by output. It's going to be defined by the labor market. And we are going to see I think the unemployment rate stay quite low.
Laura, thank you. With FS Investments, Laura Ron this morning, there were the 1.4% call, slower economy here around the buoyant news. Looking back to September 30, the end of the third quarter, those GDP statistics that we just showed, and the completeness showed, I should say, shawed, that's British, you know. It's like northern medieval British. I shawed it.
Definitely not anything related to an accent.
It's what's in the tang this morning. Okay. What I would say, Lisa, here that's so important with futures up 22, up 0.5%, and I'm going to do this on the Dow. I'm not even going to go logarithmic, but all of a sudden we're looking at record highs going back to the summer. The recent summer, and then you got to go back before that as well. A leg up off of Halloween in the present slope of good feeling from the middle of November when you bought your refrigerator. It's not as steep as the joy of early November, but nevertheless, there's a persistency to this that's without question.
And another day, S&P futures up 0.5% to 45.84. Tom, one thing I'm surprised you actually didn't bring up is just this idea that Wall Street Journal reporting that Apple has ditched Goldman Sachs, or Goldman Sachs has ditched Apple.
That's my
and
error.
The credit card. And you've been talking about the consumer banking efforts by Goldman Sachs and how it hasn't really taken off. And this is sort of the last sort of drop in that bucket. I thought it was really interesting, some of the details and the disagreements that have been simmering for quite a while between these two pairs.
Yeah, I'm not an expert on this, but I would say, I mean, I've got my own anecdotal evidence for this. There is a white card in my wallet, which I really, full disclosure, I'm not happy with. But separate from that is, and I would say this with great respect for Mr. Solomon and Mr. Cook, this thing was clumsy from day one. And I'd love to talk to Alec Webb or Dan Ives, or what's the guy we have in technology on the West Coast that gets up at 10 a.m.? He's stupid.
Ed Ludlow.
Ed Ludlow, yeah, that's it. He can never get up to talk to us. He's coming in from the bars. But I'd love to know what Ed Ludlow thinks about the clumsiness of what we've witnessed with Apple and Goldman Sachs.
Some of the details show how difficult it was from the beginning. For example, Apple's desire for there to be a very high approval rating, which led to a disproportionate number of charge-offs, things of that nature. But at the same time, this was sort of the crown jewel of the effort Goldman was really going for.
Not in acquaintance here. I can find one AirPod, but I can't find the other AirPod. Can I go get a new pair of AirPods?
Buy now, pay later. Go ahead.
Yes, thank you. I'm aware of that. Futures up 21. Bloomberg surveillance.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
We also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
some people might say that insurance is a boring business, but is that not the case?
No, I find it very interesting. I mean, you're not doing the same thing all the time. I liked it because it had a balance of doing different things at once.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also going to present risks that, other companies, how they use it and how they use large language models, and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Peter Zaffino, AIG's Chief Executive Officer, speaking with David Rubenstein, and you can watch more of David's conversation with Peter on Peer-to-Peer Conversations tonight at 9 p.m. in New York. I have to say, that really was the snippet I wanted to focus on, this question of artificial intelligence and how it's transforming, in particular, the financial industry. Tom, we were talking yesterday with Mike Mayo about just this, this event.
And also the avoidance of the shocks at something like AIG sees, whether it's a given hurricane or war in Europe, or might I point out the Eastern Mediterranean. I mean, it's a different analysis by an insurance company than worrying about what it's going to do with productivity down the income statement. Can we get more gross margin about it? Can AI help them with disaster is the heart of the matter.
I am so pleased that we get to speak with David Rubenstein, co-founder and co-chair of Carlyle Group, host of Peer-to-Peer Conversations on Bloomberg Television, because David is somebody who talks with all of the executives across Wall Street, Main Street, and beyond to understand how they're dealing with some of these transformative technologies of the moment. And David, I want to start there, kind of where the similarities are in how some of these executives are thinking about the developments in artificial intelligence, in generative AI.
Well, everybody wants to be an expert on AI and figure out how it's going to affect their company positively or negatively. But honestly, nobody really knows for sure yet how it will work. We're really in inning one of artificial intelligence in terms of how major companies are going to use it or have it used against them. So everybody's trying to hire artificial experts or get people into their firm who can help them assess whether artificial intelligence is going to be useful to them or helpful to them. And nobody really knows yet. So I can't say anybody is certain how it's going to impact their business yet.
David, Mr. Zaffino steeled at Marsh McLennan and others, and then on he goes to AIG, where different than other executives, he has to deal with disaster. What did you learn about how he handles the unexpected?
Well, insurance is about dealing with the unexpected, really. And so AIG became the largest insurance company in the world for many, many years. And as a result of that, it had enormous tentacles throughout the entire financial complex. It clearly extended itself too much, didn't anticipate problems that arose, particularly in the mortgage area, and as a result had to be bailed out by the U.S. government to the tune of about $180 billion. Now that money's been paid back with interest, but AIG is no longer the biggest insurance company in the world and doesn't have quite the tentacles around the world that it once did, but still a very profitable company.
David, a newsmaker yesterday, this is what Rubenstein does. He's steering the thunder from journalists. David Rubenstein with Bill Ackman yesterday on the track that this nation will take. What did you learn from Mr. Ackman, David Rubenstein?
Well, Bill is a very impressive person who obviously is outspoken, has been outspoken on many issues over many years. Recently, he's become quite visible in what he's been saying about Harvard. But he said in the interview, which will air not too long from now, that he's made a new bet. He's made a number of macro bets that have turned out to be extremely positive. One of them, he made over 100 times his money on a bet that he made a number of years ago in the time of COVID. Now he's made a bet that interest rates will be cut sooner by the Fed than is otherwise expected. And if that bet is successful, I guess he'll make a fair amount of money. But that's the big issue that many people are grappling with. Will the Fed decide that it needs to lower interest rates before the political season starts, let's say in the summer or the fall of next year?
Dave, excuse me. Go ahead, Lisa. please. My fault.
David, is it surprising to you that a big hedge fund manager is focused on making big bets on treasuries right now?
Well, many hedge funds people are doing that, honestly. He has not done the so-called treasury trade that others have done, where he's buying treasuries and shorting treasury futures. He hasn't done that. This is basically a bet that the Fed will succumb to some pressure to lower interest rates before too long. Now, the conventional wisdom in Wall Street is that the Fed will lower interest rates at some point during the first or second quarter, more likely the second quarter. I think his bet is it'll probably do it sooner than the conventional wisdom. And I have said publicly before, and I still think it's the case, that the Fed will get in trouble if it lowers interest rates around the political season, because Republicans will say, well, you're helping Joe Biden by lowering interest rates if you do so over the summer or in the early fall. So if the Fed is going to lower interest rates, probably to avoid political criticism, it'll have to do it sooner than later.
David, you mentioned Mr. Ackman in Harvard and the horror of the Eastern Mediterranean. I want to go to your Duke University, where they have a bridge, folks. It's an old bridge called the Free Expression Bridge. And to make a long story short, they had to paint over a pro-Palestinian tone as well. David, I want you to talk to the great and good right now about how those of means and success should deal with their shock at our American universities.
Well, the American university system is still the envy of the world, and our private universities are really places that people from all over the world want to attend. There's been a shock that many people didn't realize how strong the anti-Israel feeling has been in some campuses, and the result of that has been outraged by some alums. Some universities have handled this better than other universities. I am the chairman of the board of the University of Chicago, and we have a tradition of not issuing statements on political matters or outside matters, and we haven't issued one in this case. But in many cases, other universities have not had that policy, and they've gotten in trouble for issuing statements that don't please one side or the other. It's a difficult way to walk this fine line, and I don't know that anybody has figured it out properly or correctly.
David, a glorious day for Bloomberg surveillance with Doug Cass and Howard Marks with us in remembrance of Charlie Munger. Give us your thoughts on the hugely successful experiment that was Berkshire Hathaway.
For those who don't know, Charlie Munger was from Warren Buffett's hometown of Omaha. He moved to Los Angeles and later reconnected with Warren Buffett, who he hadn't really known before, but he had worked for Warren Buffett's grandfather at one point in a store. Charlie Munger was an outspoken, very, very smart lawyer who transitioned from being a lawyer to being an investor, and his track record early on was actually better than Warren Buffett's in some respects. They teamed up, became an incredible team of people who were mostly known to the public through their annual meetings, where Warren Buffett and Charlie Munger would answer questions for 6 hours on end. And Charlie Munger was quite well known for his, I would say, dismissive ideas of some other people's thoughts about investing. He was a very fundamentalist kind of investor, and he transformed Warren Buffett. Warren Buffett was taught to buy things very cheap, and buy things cheap, you can always make money. It was Charlie Munger's view that you should buy good companies. Maybe you pay a reasonable price for it, but buying good companies is better than buying cheap companies, which may not be that good. And Warren Buffett gives a lot of credit to Charlie Munger for having transformed his views on the investment world.
David, thank you for joining us today with this remembrance of Charlie Munger and, of course, with your excellence. Look for a conversation with Peter Zaffino, peer-to-peer conversations, 9 p.m. tonight, and hugely anticipated in the next 10 days, a conversation with Bill Ackman that moved, I would suggest, moved markets, at least the trading market yesterday.
Well, Bill Ackman has gotten the timing pretty well so far this year. I think it's notable to me that hedge funds have been active players in making interest rate bets. Back in the day, they were more of the Charlie Munger make a big bet on a specific company, including Bill Ackman with his whole Herbalife saga. There is a question of whether interest rates are actually at the behest of some of these levered trades and how much that's played into the action of this year.
The action of this year is the bid is there. Even on moldy days, stocks seem to have, there's just this oomph right now. I guess it's seasonal. Some people would say that. Amy Wu Silverman would say that. But I got futures up 21. For the first time, folks, in years, I'm on like a record high watch on NASDAQ 100, a 16.1 and 16,500-ish is a record high. I've never said that.
It's the NASDAQ up 11%, more than 11% so far in November. It's been a great year, right? We were hearing that earlier this month. It's the month of November. But honestly, we did see that 10% pull down and boom. Was that enough to bring everybody back in?
I think I've got to see what Apple's Christmas holiday sales are before I can buy my first share of stocks. I triple leveraged all cash. You know, I mean, somebody said, do you really make 15%? 5 times 3, and I said, no, there's a lot of expenses involved. There's marketing expense, and, you know, the general counsel has to get their fee, and, you know, net clean, we're double digit, but we're not up at 15% as some people think.
You say that Apple revenues are going to be interesting. How much is it just going to be CPI, PCE, what we get from U.S. inflation? That's going to drive more valuations.
Well, and also, I'm going to go right over to the job economy. What if we get all this secret sauce John and Lisa are talking about in a fully employed America? I have to see on that. What it is a fully employed General Motors, and they will be making cost cuts. They make that very clear. Their CEO in conversation with our John Farrow here in this hour. It's Bloomberg Surveillance. Good morning.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths. I have different strengths.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
What do you worry most about your economy and Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, you know, in 5 years from now, we will not have sacrificed, you know, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Let's get your trading day started. Live from New York City this morning. Good morning, good morning. Your equity market looking pretty good. Up 0.5% on the S&P 500. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
from New York coming up. Equities heading towards a big month of gains. As one Fed official signals he's most likely done, bets growing, rate cuts are just around the corner. We begin with the big issue, the hawks sounding like doves.
It's a dovish message. Pretty strong pivot from Fed members yesterday. That is quite key. That is quite a game changer.
This is definitely adding to the expectations of the market for a cut.
What will be key now is whether Powell reinforces that.
They're going to have to sort of balance the message.
They're trying to kind of thread the needle here.
There's an element of we don't want the market to get too ahead of itself.
If we were to just rewind a few weeks ago, the tune from the Fed was very much about higher for longer.
The trend is very clear.
We do have a slowing U.S. economy.
Inflation is probably coming down.
There is clear evidence that the labour market is starting to loosen.
The Fed is getting what they want.
The Fed is basically out of the way here.
The Fed is likely done hiking.
There's an element of this is our best guess and we're changing it as data evolves.
We've got a couple of important data points in the next few weeks.
And some soothing words from Governor Waller. Boom, bond market rally, yields lower. Let's have that conversation. Crossmarks Bob Dole, Richard Bernstein of RB Advisors. Gents, great to catch up with you. Bob, first to you. We heard from Governor Waller, a suggestion, no more hikes. Governor Bowman saying something completely different. Why did we ignore one and listen to the other?
Great question. I think investors are confused, and therefore, whatever the latest move has been, they accentuate that on that side. But I think it's pretty clear the Fed doesn't know what they're going to do next, and therefore we investors probably don't know either. Look, the Fed is either done or very close to done. I think the debate will be how many months is it before they contemplate lowering rates? How weak will the economy be when they actually do it? And where will the inflation rate be? A lot of tough questions.
That haven't been answered, and yet still massive moves in this bond market. The 10-year's gone from 5% to 4.30. The 2-year's gone from 5.26 to 4.67. Richard, do we have selective hearing in the Treasury market?
I think, Jonathan, we do to some extent. You know, the GDP number that came out this morning showed the strongest nominal economy in 20 years outside of the immediate post-pandemic, surge. This is the strongest quarter we just had in 20 years in the nominal economy, but yet everybody is convinced that rate cuts are on the horizon, and some people are still forecasting recession. So that would imply an immense collapse in the U.S. economy, something that we've never seen without calamity like a pandemic or 9/11 or something like that. So I think people are being quite optimistic here.
Bob, let's talk about that optimism, the happy talk. The consensus view at the moment seems to be below trend growth, no recession, but you'll get your rate cuts by equities. Bob, what's the reality check for you this morning?
That PE is approaching 20 again. That makes me nervous. And every time I turn around, estimates for the fourth quarter or next year are getting cut. That doesn't give me a lot of comfort that I should buy stocks at 4,600.
So 45.84. Have you still got a range of 42 to 4,600?
Yes, and when we get to 42, I get interested in buying. And obviously, we dip to the low 41s. As we approach 46, I'm a trimmer.
Beneath the surface, Bob, what do you like?
So I think that having stocks in your portfolio that have good cash flow characteristics, have reasonable earnings predictability, reasonable earnings persistence, those kinds of things tend to work in the uncertain world which we find ourselves.
Doesn't that take us to the Magnificent Seven?
Yeah, you got to own some of them. I'm not disagreeing with that. Valuation's always one of the variables we have to look at, but relative to what they're able to produce and the consistency of what they produce, several of those stocks are not all that expensive. Our favorite is Microsoft among that 7.
Richard Bernstein, take the stage. Richard's words, magnificence beyond the Magnificent Seven. Talk to me, Rich, about that magnificence.
Right. So John, our story is basically that one could understand the Magnificent Seven and their dramatic outperformance if they were somehow unique. If there were only 7 growth stories in the world, it might make a lot of sense to see what we're seeing. The unfortunate reality is that there are tons of growth opportunities. In fact, there are many stocks whose earnings growth is far surpassed that of the Magnificent Seven, whether you look on a historical basis or on a forecast basis, suggesting that there's a broad range of growth opportunities, both in the United States and outside the United States. So that says that the rush towards 7 stocks is really pretty irrational and is really just a momentum market, not unlike, speculative momentum bubble type markets we've seen before.
That was true 12 months ago, and here we are staring at double-digit gains year to date. What changes that?
I think what's going to change that, if we're right, and if the economy is not falling into recession, and the Fed isn't going to start cutting hand over fist, which seems to be the consensus, and there's not going to be tons of liquidity flowing back into the financial markets, and financial conditions start to tighten again, that would end, history says that would end the Magnificent Seven. We saw that in 2022. Right, where the Fed was tightening and Magnificent Seven were down 40, 50, 60%. So I don't see why people would be so confident that that couldn't possibly happen again.
To your point, that word confidence, there is tons of confidence that next year the rate cuts begin. Your 2-year is down another 7 or 8 basis points at the front end to about 4.66. Mike McKee has the latest on the Fed speak. Morning, Mike.
Good morning, John. Well, this is the thing that moved the markets yesterday, and that was, as you were mentioning, Christopher Waller suggesting that maybe rate cuts could come next year, because Fed officials have been pushing back on that idea for quite some time. Here's what he sees. He's encouraged, he says, by what they've learned in the past few weeks. Something appears to be giving, and it's the pace of the economy. And here's what he means by that. Never mind the 5.2% revision, upward revision today to third quarter growth. It's the fourth quarter that matters now, and the Atlanta Fed GDP, we're using that as a proxy for pretty much everybody's forecast, looks like it's down to 2.1%. Which means a halving of growth, more than a half of growth. And the idea is that would bring down inflation. I do have some good news for Bob Dahl, though, and he said he doesn't know whether he wants to invest right now. Corporate profits in the third quarter, first time we get that is in this second release, and they were up 3.3% compared to just 0.2% in the second quarter. So there's some good news. You were talking about Mickey Bowman and whether she was speaking something different from Chris Waller. She's talking about the idea that maybe inflation could go back up, in which case she'd support rate increases. Not that rate increases have to happen. She says we should keep in mind the historical lessons and risks associated with prematurely declaring victory in the fight against inflation. And here's what she is talking about. You can see that economists have tended to overstate inflation. This is PCE inflation, which we get tomorrow. It's the Fed's measure of inflation, the one that they benchmark their 2% rule to. And the markets have come in much higher than that in recent weeks. And you can see the consumers, the yellow line there, they look like they're going to see inflation almost double in the next month or so, whereas the consensus sees it dropping. So there's a lot of uncertainty about what's going to happen with inflation, even if the economy slows. So that gets back to, I don't have anything more definitive than what you guys were saying, is nobody really knows at this point.
It's over to you, Chairman Powell, on Friday. Mike McKee's going to continue covering some of the incoming Fed speeches you can expect between now and then. Chairman Powell in Atlanta, I believe, this coming Friday, just a couple of days away. I want to return to that line from Governor Waller. Something appears to be giving, and it's the pace of the economy. Richard Bernstein, why is the Q3 boom still relevant to you, given what Governor Waller's saying now?
Well, I think, John, it's nobody expects the third quarter to be repeated. I mean, that would be incredible to have that happen. But I think the important thing to think about is, Michael mentioned this very briefly before, corporate profits are starting to rev up. The profit cycle has troughed. And if the profit cycle is troughing, and on S&P basis, we're going from about minus 10 to 15% to what could be 10 to 15% profits growth in 2024. If that happens, we should expect the labor markets to get tighter, not easier. We saw the weakness in the labor markets. Whatever weakness we saw was during a profits recession. That profit recession, as Michael just pointed out, is over. We should expect hiring to pick up as we go out of that profits recession towards a profits expansion. Labor market's already tight. It's not going to get easier. It's just going to get tighter, which will put pressure on wages, which will put pressure on inflation. So I think, whether it's 8% nominal GDP or 5% nominal GDP, whatever you want to put in there, the reality is the economy is not dying. And I think that's the important point. And I think inflation pressures will remain, maybe to a lesser extent, but they will remain. And I think they'll be kind of stubborn.
Bob Dahl, what's your response?
If nominal GDP is in the 5 to 8% range, I agree with Rich. That makes things tight. It puts pressure on the inflation rate. It causes the Fed not to contemplate cuts, but maybe raise rates again. I do think the economy is slowing. We've seen that in some of the more recent labor statistics. And I think that will create the confusion that we're now in to continue. Are we done? Where's 2%? Oh, it's still 4%. Nominal GDP slowing. The estimate cuts that I referred to earlier for the fourth quarter and next year, I think will continue.
These debates haven't been settled. We'll continue the conversation. Bob Dole, Richard Bernstein sticking with us. About 20 minutes out from the opening bell, equity futures up here by 0.5% on the S&P. Let's get you some movers and say good morning to Abby.
Good morning, John. And for that move for the S&P 500, the best possible day in more than a week. Helping out, let's take a look at what's helping this bullish tone. Workday shares of the cloud company are up nearly 10% after they beat both top and bottom line estimates. They also raised their subscription revenue forecast modestly to $7.7 billion. But analysts really liking it. Price targets by many banks and firms raised, including D.A. Davidson. Foot Locker up 12.4%. Its best day since August of 2022. They put up a 37% earnings beat for 37 cents per share in adjusted earnings. And it's some proof that the strategic plan is working. Plus, they raised the full year view. They're very bullish, saying that the Thanksgiving weekend was strong, confirming some of the data that we've had recently. And then finally, GM up 10.7%. Its best day right now, I believe, since March of 2020. It's soaring after boosting their dividend by 33%. They've also announced a $10 billion buyback, the biggest ever, down 14% year to date, John, into today. But let's see whether or not that gap's going to close.
Massive move this morning, just huge. Think about it. Yesterday at the close, $40 billion name, $40 billion market cap this morning, $10 billion buyback. 9:30, don't miss it. Conversation with GM CEO Mary Barra. Just around the corner. Just around the corner, the opening bell, and coming up next on this program, consumers buying now, they're paying later.
You have to pay the bill, right? And you talked about pay now or pay later. I think as we are saying high for longer, the bill is higher probably for the consumer than some people might think.
That conversation up next.
Let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
On the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
You have to pay the bill, right? And you talked about pay now or pay later. I think as we are saying high for longer, the bill is higher probably for the consumer than some people might think. You have still some consumers that want to spend really, as you rightly said, I think But if you hear more that the economy is slowing down, and so far we have not heard so much about this, to be very honest, I think then the consumer will also lower expectations and react to this.
The time has come to buy now, pay later. Delayed payment options are booming, with Adobe Analytics expecting a record month for usage. Cyber Monday activity hitting an all-time high, surging 43% year over year and contributing $940 million in sales. Payments company Block saying its Afterpay platform saw a 19% increase in purchases compared to last year, with sellers on Square seeing transactions grow 47%. Katie Greifeld has the story. Morning, Katie.
Good morning, John. Yeah, buy now, pay later. It's the clear early winner in this holiday shopping season. Those numbers that you ran through just now, that 43% jump in BNPL. It also has Wall Street changing its tune pretty quickly. I want to point to Jefferies' John Hecht, for example. He upgraded Affirm from sell to a hold this week. He wrote that BNPL is gaining momentum as consumers basically juggle with high inflation, dwindling savings, some of those factors that we talk about all the time. And interestingly, they're using BNPL not just for the big ticket items, but also turning to these services for essentials, including gas and groceries, which is a real sign of the times here. But that's to the benefit of these payment companies, such as Affirm, which is higher by more than 200% this year alone. Of course, that follows a brutal couple of years, but 200% nonetheless. There are a few asterisks here. It's not all blue skies. Competition obviously growing from some deep-pocketed rivals. I'll point your attention to Apple, which introduced a similar service earlier this year. You also have delinquencies rising as well, basically the pay later part of buy now, pay later. Bloomberg Intelligence notes, though, that the greater risk for Affirm and some of these other services at this juncture is actually from a volume slowdown rather than credit losses, especially as you have student debt forgiveness coming off. So we'll see if Affirm and some of these other services can actually build on this momentum that they're seeing.
Katie, thank you. I think a question for us all, is it a boom now and a bust later? Bob Dole, Richard Bernstein back with us. Bob Dole, record Black Friday, record Cyber Monday, airports packed over the weekend. What matters more, how much consumers spend or how they spend?
I think the amount is clearly important. We'll worry about paying later, as was pointed out. Look, Americans were born to shop, and if they're working, they're going to the mall and they're shopping, and that's exactly what we're witnessing. Consumer discretionary sector was the best third quarter earnings surprise, 13 percentage points better than expected. So that's where the action is for now.
For now. Richard, let's talk about the for now piece of this. Why isn't this the final fumes of the post-pandemic spending boom?
Well, John, I think that's going to depend on the labor markets. And, normally in a late cycle environment, you would start to see the labor markets even contract, if not weaken. That's not happening right now. So, income is the #1 determinant of spending. Jobs are probably the #1 determinant of income. So if the labor market stays tight and we continue to see wage gains, which there's tremendous anecdotal examples. Think of all the strikes and everything else that we've seen. You don't get that in a weak labor market or a weakening labor market. That's obviously symptomatic of a strong labor market. So as long as the labor market stays healthy, which I think it will because corporate profits are probably going to stay healthy, that means the consumer will probably end up being healthier than people think. Although I do love Bob's comment about Americans were born to shop. That's fantastic.
They seem to be, based on the numbers we've seen over the weekend. Bob, to Richard's point, the labor market, the labor market, the labor market. Tomorrow morning, jobless claims. I think a lot of people miss this going into the Thanksgiving holiday, but to see jobless claims drop back to 209, Bob, after climbing for a few weeks, there was a suspicion that maybe that labor market weakness is just around the corner. Bob Dole, based on the data we're seeing, the spending we're seeing, 209 on claims, maybe 218 according to our forecast going into tomorrow. But what's the argument against this labor market strength?
Well, as you point out, prior to last week, there were some questionable numbers. It's not going to be all of a sudden most likely falling off a cliff. It's going to be this number's okay. The next 2 weeks, not so much. Look at the monthly employment numbers slowing to 100,000, which is about what's needed to keep the unemployment rate flat. But up 100,000 jobs, that's way down from where we were. So it seems to me in an irregular way, the labor market is slowing. it's not weak, but it's no longer as robust as it was.
Bob, it's so difficult to navigate because the headline numbers still look pretty decent. We've just talked about record spending. There's some cracks there in terms of how the consumer is spending for that. We know about delinquencies. The retailers warned that maybe we should have some caution around what the holiday spending period could look like. Best Buy was one, Walmart another, talking about deflation. Then you get names like Foot Locker saying things weren't so bad. Stock is surging in the pre-market. When it comes to the equity call, Bob, do you want discretionary right now, or do you want staples going into next year?
I'm not crazy about either sector. Staples would be the contrarian move. Discretionary, having bought some of those opportunistically, turning around and trimming now because my view is, as you can hear, is things are going to slow.
Richard, what about you?
So John, I view this very simplistically, that one has to remember the cycle is determined by cyclicals. And so if that's true, and we think profits are going to start revving up again, going from like minus 10 to 15% to plus 10 to 15% as we go into 2024, that would argue for more cyclicality. The problem with the consumer discretionary sector is it's dominated by a handful of companies. So I don't mind consumer discretionary on an equal weighted basis. I don't particularly find it attractive on a cap weighted basis.
That seems to be your approach at the index level as well, not just the sector level. Richard, is that right? It's an equal weight S&P as opposed to a market weight S&P?
Absolutely, absolutely. We at RBA view the market as a seesaw right now. And on one side of the seesaw, you have 7 stocks. The other side of the seesaw, you have everything else virtually in the world on the other side of the seesaw. And we think there's honestly a once-in-a-generation opportunity on the other side of the seesaw away from those 7 stocks.
When you equal weight the S&P, I understand what you're trying to dilute, remove the muscle from, and that's big tech. When you equal weight discretionary, is that just about Tesla for you, Richard, just the makeup of that sector?
Yeah, I mean, it would be probably, I don't want to name names, I'm not a stock picker, but something like Tesla, Amazon, the big, you want to get away. I think, look, when you have 7 stocks dominating the market, John, I think it's a time for maximum diversification. However one wants to get that, whether it's equal weighting, whether it's avoiding, whether it's looking elsewhere around the world, however you can diversify your portfolio, when 7 stocks are dominating, it's a time for maximum diversification.
We'll see where things stand in 12 months. We'll catch up before then. Richard Bernstein, Bob Dobb, to the two of you. Gents, thank you. As always, coming up, the morning calls, and later, GM taking steps to return billions of dollars back to shareholders. That stock is up by more than 10%. We'll speak to the CEO, Mary Barra, in about 7 minutes' time.
What did you learn in the last 40 years about leadership in politics?
Well, I've been learning a lot about leadership for a very long time, observing it in others, recognizing what is needed to get the job done. And I always define it in this way: know your why. You have to know why you're doing this, because you will be under attack, this for sure. Know your why, know what you're talking about, know how to get it done, think in a strategic way, and then that's all up here. And then also connect directly with people. If you can show them how important what you're advocating is and what you know you're talking about, so they trust your judgment, and you have a plan, you will have followers. You will be a leader.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
this stock market is hearing what it wants to hear, and it likes what it hears. About 5 minutes out from the open, and Bell equity futures are positive here by 0.5% on the S&P. The bigger move yesterday, though, right here in the bond market. Switch up the board. Take a look at the 2-year. The 2-year yield. Only a month or so ago, we were talking about 5.26 on a 2-year yield. Now we're all the way back down on a 2-year to 4.66. Think about where we've been and where we are on a 10-year maturity. That yield right now, currently, a break of 4.30, 4.29. Only a month ago, through 5%. Governor Waller speaks yesterday, says something's giving, and it's the U.S. economy. He doesn't want to talk about the Q3 boom. He's thinking about the Q4 slowdown and the prospect of rate cuts in our future. That gets this market thinking maybe those rate cuts are just around the corner. That's the price action. Let's get you some morning calls this morning. Your first one from Jefferies, downgrading Airbnb to hold 140 price target, pointing to a recent slowdown in bookings. That stock is negative 0.4%. Piper Sandler downgrading Hershey to neutral, expecting ongoing headwinds from higher prices. That stock is just about unchanged. And finally, Citi raising its Micron price target up to 88, recommending investors buy the name on any weakness due to improving demand. That name is up by a little more than 1%, 76.92 in early trading. Coming up on this program, General Motors unveiling plans to reward shareholders. Massive plans, $10 billion buyback, big hike to the dividend. The stock is higher by more than 10%. Up next on this program, the GM CEO, Mary Barra.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
25 seconds away from the opening bout this morning. Good morning. Your equity market positive by 0.5% on the S&P 500. On the NASDAQ, up by 0.6%. That equity market helped out big time by big moves in this bond market, encouraged by some dovish Fed speak in the last 24 hours. There's your opening bell in New York. Switch up the board and get to the bond market. Yields lower again on a 10-year by 3 basis points. We have broken 430, 428.98 only a month ago, talking about 5%. Bang, much lower. In the FX market, the dollar showing some strength against the weaker euro. Not the trend over the previous 4 days, but back to about 109.81 on that currency pair. Crude higher by 1%, $77 and about 30 cents. About 20 seconds into the session, your equity market shaping up as follows. Up here by 0.4% on the S&P. On the NASDAQ, up by 0.6. One stock to watch at the open, Foot Locker. The retailer raising its full-year forecast. Abby on top of this one. Hey, Abby.
Shares absolutely soaring on this one, John. Heading to the best day since November of 2020. They finally put up a good quarter. It's been a difficult year. The stock is down about 38% coming into today. Lots of inventory issues, having to rely on promotions. But in this particular quarter, the third quarter, they did beat comp sales, putting up a comp sales of minus 8%, down 8% versus the estimate of down almost 10%. Adjusted earnings of 37 cents, beat by about 37%. So lots of good there. They are also saying that their Thanksgiving week, very strong, confirming the data that we've had, at least for relative to online shopping and bricks and mortar shopping. And as a result, this is one piece of why they've raised the full year outlook. Now, today's big pop up 17.4%, again, the best day since November of 2020. It may not just be outright buying. There's a big short interest on this stock, John, of about 11.5%. So this could be a bit of a short squeeze as well.
Stock is flying up 17%. What do casinos and the Dallas Mavericks have in common? Simone Foxman's going to tell you. Hey, Simone.
Yeah, well, the drama for Las Vegas Sands began after the bell yesterday. We got the announcement that Miriam Adelson, the largest owner of Las Vegas Sands shares, would be selling $2 billion stake. That's equivalent to 46.3 million shares. Subsequent filing soon made clear why. It said that Adelson intended to buy the majority stake in a sports team. We later learned from sources that that is the Dallas Mavericks, and that is the connection there. This is the NBA team that's been owned by Mark Cuban since 2000. Of course, no one is commenting on the story at the moment, but what's moving the stock here today, and we're lower by about 3%, is that the offering for this $2 billion worth of shares priced at about $44 a share. That was a 7.7% discount to the closing bell price. And the term sheet said some investors wanted a discount of as much as 10%. Of course, the company, though, going in and saying it's going to buy back $250 million worth of shares as part of this offering. Overall, though, no big changes at the company. No one's changing control. Adelson still remains the controlling shareholder, but shares have lost all their gains since late October.
The stock is down this morning by 2.8%. Simone, thank you. Let's turn to China briefly. Shares of Alibaba moving lower. Jack Ma urging employees to, quote, correct course. Ed Ludlow has this story. Morning, Ed.
Yeah, morning, John. This is a shock move. Jack Ma hasn't really been operationally involved in Alibaba since 2020. The stock is way off its 2020 pandemic high. We know about the plan to restructure into 6 individual units. That has largely been scrapped with the cancelling of the plan to spin off the cloud business. The most notable part of it, according to Bloomberg Intelligence, was Jack Ma noting the competition from Pinduoduo, the owner of Temu in the e-commerce space, and basically congratulating them for their performance. You'll remember earlier this week that Pinduoduo had a blockbuster earnings where revenue grew 93% year on year. This is a rallying cry from Jack Ma, very unusual occurrence, and puts a little bit of pressure on the 2 co-CEOs, Joe Tsai and Eddie Wu, who are trying to plot a path forward for this company that is underperformed year to date.
Ed, thank you. Pulling back just a touch. Let's talk about a name going in the other direction. Big moves from GM this morning, and the market absolutely loving it. Katie, that name up around about 11%.
Yeah, GM shares flying at the moment. Let's start with the why. The 33% boost to the dividend. GM raising its quarterly payout by 3 cents a share to 12 cents beginning next year. That's in addition to a $10 billion share buyback plan. That is the biggest ever in GM's history. You can see shareholders clearly like that. Now, GM also reinstated its 2023 earnings guidance to levels modestly below what it had before the 6-week strike by the UAW cut into profits. GM said that net income will now be between $9.1 to $9.7 billion. Previously, that range was between $9.3 to $10.7 billion. So clearly, that 6-week strike left a mark, John.
It's just amazing to see that move off the back of this plan. Some big numbers out there. Katie, thanks for that. GM up this morning by a little more than 11%. Joining us now, I'm pleased to say, on Bloomberg TV and on Bloomberg Radio, GM CEO Mary Barra. Mary, wonderful to catch up with you. Your stock is loving you this morning. We'll get into that in just a moment. I want to go through some of the numbers for our audience. Dividend up 33%, biggest ever buyback plan, $10 billion, $40 billion name yesterday. Just for some context, perspective there, that is massive. Inquiring minds, Mary, will want to know, why have you decided to deliver a $10 billion buyback shortly after you've signed a labor contract that adds $9.3 billion to expenses over its term?
Well, as we looked at what was happening from a labor perspective, we had built, and really the labor environment going into our negotiations, we had put conservative estimates into our plan. So although it was a little higher than what we expected, we believe that we have, and our guidance for next year we've already said that we'll be able to offset that completely with the plan that we already had of a $2 billion cost out perspective. So we did the right thing to recognize our manufacturing team members who have done a great job and continue to build vehicles safely with high quality. And we also thought that we've got to look and make sure that we're balanced across all of our stakeholders, and our owners are very important. So we think this was a very balanced response when we look at what was done from a labor perspective and what we're doing as part of our capital allocation framework for our owners.
Well, let's get into that. So shareholders are super happy. The name is up by almost 11% so far this morning. I wonder if UAW is. Mary, they didn't get the 40% they wanted. They got 25 plus cost of living adjustments and other things as well. Is the optics of this morning not something that concerns you?
When I look at it, I think it's balanced. Again, we have very well compensated, and when you look at the suite of benefits that our represented team members have, it's a very appropriate package, and frankly, leading from an industry perspective broader than just the auto industry. So I think we did the right thing to recognize and reward the hard work of our manufacturing team members across the board. But also, one of the things our manufacturing team members very much value is job security. And to have job security, you have to have a strong company, and you have to look at all of your stakeholders. So what we did from a share buyback perspective for our owners is, I think, a very balanced response.
As you know, this move this morning, not just about the capital return program, also about cost cuts. We know you're looking to fully offset that labor contract, the additional costs from it. Have you identified where you will cut, where you need to cut?
Yes, a lot of this was already underway. At the beginning of this year, calendar year 2023, we announced a $2 billion cost reduction, structural cost reduction between 23 and the end of 24. That's well underway. As I said, we also comprehended that we would have increases in our labor cost as we looked at what the environment was, and also wanting to reward our manufacturing employees. So, there's work going across many aspects of the business, and including making our products more efficient while still having the features, the functionality, and beautiful designs that our customers want. So there's been a concentrated effort at the company to lower our fixed costs while enabling wonderful products and rewarding the team that is helping us deliver them.
Clearly, these are additional costs. Are they forcing a change in execution or a change in strategy?
Definitely not a change in strategy. Our strategy is clear. It's really based on 4 pillars of executing our strong internal combustion engine program vehicles, and we see we're performing very well in the market, and we see that we're below the average incentives. I think that speaks to the strength of our internal combustion engine products. From an EV perspective, we have confidence in the portfolio we have. We're a bit disappointed this year that we were constrained by the automation to build modules, so this is not something that is fundamentally an issue with Ultium. It was more a manufacturing automation issue that we're working, and we'll be out of it by middle of next year and making improvement every quarter from that perspective. Also software, and this year earlier this year, Mike Abbott joined our team, who brings tremendous software expertise, and he's built a very strong team that we'll share more about when we get to our Investor Day in March of next year. And then autonomy. And when you look at autonomous vehicles and the importance of this technology and the talent that we have at Cruise, we are doing an independent review from an incident perspective, but also overall from a safety perspective, and that will guide our path forward there. But we have a very capable team there. So the 4 pillars of our strategy have not changed at all. What has changed is our tactics, and our tactics are changing because the world is changing. We never thought that the EV adoption would necessarily be a straight line. We've seen this in other markets. We're seeing it now in the US, but I think the thing that everybody has to remember, if the growth is slowing, it is still growing. And we think as we get more of the EV products we have this year into next, we think we're gonna see a strong adoption for our products. And as the charging infrastructure continues to be more robust, we think that's gonna drive adoption as well as having affordable EVs. And that's where when you look at the Chevrolet Equinox as well as the Blazer and the Bolt that's coming, we're going to be having products in that range of affordable vehicles that is going to be very important from EV adoption.
2 things to unpack there. One is robotaxis, the other is EVs. Let's deal with robotaxis first. You're cutting expenses on Cruise substantially. Just how committed are you there? I remember only a number of years ago we were talking about bringing in $50 billion in revenue by 2030, and I get it, Mary. We all understand that new tech is tough to develop, it's hard to deploy. I think we're seeing that across a range of issues. But when do you know if it's the right time just to walk away from this?
Well, I think first of all, when you look at the progress that the Cruise team has made over the last 8 years when General Motors acquired Cruise, I think it's substantial. And we've already demonstrated that the Cruise vehicle can perform at a level that's safer than a human driver. Let's not forget, over 40,000 people on average lose their lives in traffic accidents in the U.S. alone, and 90% of them are caused by human error. What we have learned with this incident is it's got to be significantly better than a human driver to drive adoption, and we have to do a much better job of working with the regulators. That's something that GM has a long reputation of working and being transparent with regulators at the local, state, and federal level. So I think as we do that and get the results of the independent review we're doing, that will guide us on our path forward from a AV perspective.
I'm always interested in how we know when we're wrong, an exercise I think everyone has to go through, including myself, Mary. But on this topic of EVs, the slowdown, what's behind it? And why aren't we just learning that American consumers just don't want these cars?
Well, I don't think it's that American consumers just don't want these cars. I think there still is limited availability when you look at the choice that customers have today from an internal combustion vehicle perspective. I think a lot of the EVs that are out right now are more expensive. You've got to look at where the sweet spot of the market is. And when you really want to win in EVs, you've got to make sure that you are beating the customer who only owns one vehicle. That's the bulk of people who buy vehicles today, new vehicles. They only own one vehicle, or if they have 2 in their family, they're needed every day to earning their livelihoods. So we've got to get affordable. There's got to be a robust charging infrastructure. So again, the growth hasn't gone in reverse. It's slowing. I think we never expected. We thought it would have some bumps along the way. I think that's what we're seeing right now. But I think when we have EVs that are affordable, when the people realize how much fun they are to drive and the performance, and they're not giving anything up, and then that all-important charging infrastructure, I think we're going to see them start to grow at a more rapid rate again. And that's something that we'll continue to watch, and that's why we've changed some of our tactics to be responsive to where the customer is.
You've been super generous with your time. Mary, I just want to fit in one further question. Right now, you're a $43 billion name. It's a big move this morning by 10%. The forward multiple, we're talking about 4 times expected earnings, a little more than that after today's move. The stock has been dead money for the best part of a decade. You've been doing this a long time. I know you're super close with investors. What is it that you think is in this plan, this strategy that you have, and a strategy that you've suggested this morning hasn't changed, that's going to turn this around?
Well, I think demonstrating our commitment to all of our stakeholders, and I think when you look at a $10 billion accelerated buyback program, it should signal, because it means we have confidence in the cash generation ability of this company. We have confidence in our strategy across the 4 pillars that I covered. Yes, we had some challenges this year with our Ultium-based EVs that I think gave investors some concern, but we're demonstrating the confidence that we and the board have that we're executing the strategy, and we're going to see growth, strong cash flow, and strong margins. That's what we're going to deliver.
That's captured in today's move, up 9%. Mary, appreciate your time. Really do. Thanks for catching up with us. Mary Barrett there of GM. The latest on General Motors. The conversation will continue around the equity market. Coming up, global equities poised for their best month since 2020.
some people might say that insurance is a boring business, but is that not the case?
No, I find it very interesting. I mean, you're not doing the same thing all the time. I liked it because it had a balance of doing different things at once.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point! From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
As we looked at what was happening from a labor perspective, we had built, and really the labor environment going into our negotiations, we had put conservative estimates into our plan. So although it was a little higher than what we expected, we believe that we have, and our guidance for next year we've already said that we'll be able to offset that completely with the plan that we already had of a $2 billion cost out perspective.
GM CEO Mary Barra speaking moments ago. The automaker making its case to Wall Street, rewarding investors. The stock higher in the first 20 minutes or so of trading. Abby has more. Hey, Abby.
Hey, Don. Yes, we do have GM trading higher, heading to its best day kind of between 2021 and March of 2020. Investors really responding very positively to this news in terms of the company raising the dividend by 33% to that translates to 3 cents per share on a quarterly basis, and then the buyback of $10 billion, the best ever. Now, on the year into today, GM really struggling to some degree. The stock had been down about 15%, but investors seeing this perhaps as a turnaround. Something else to think about, John, is the possibility of broadening out. As everybody's been focusing on the Magnificent Seven, investors may be looking for the next companies, stocks that can be the up-and-comers.
That's precisely what Richard Bernstein was talking about earlier in the hour. Abby, thanks for that. Waiting patiently for us to react to that interview, Sarah Hunn of Alpine Saxon Woods. Sarah, let's get into it. From an investor's perspective, just how investable are some of these names in Detroit?
Well, I think that one of the reasons that they're changing some of the capital allocation is for exactly that reason. I mean, these are relatively mature industries. Most people have a car. It's not like a brand new technology. But moving to EV, I think, is difficult. And I think that part of what she's saying is it reflects some of that difficulty, which is that for a lot of people, especially if you live in any kind of an urban environment, that charging infrastructure isn't quite there to make it simple for people to use. So you had a huge adoption for the first adopters, like you do with a lot of new technologies. And now people are sort of sitting back and saying, I'm not quite sure I want to do that. So sort of like energy, I think the internal combustion engine has a much longer tail than people would like to assume it will. And I think that trying to balance that out right now is difficult for those, especially in a high capital cost industry.
Considering that difficulty, Sarah, is this a value trap or a value gap?
Well, I think that part of, again, from our perspective, if a company is putting their cash flow on the line and saying, we're going to do this with our cash and we can generate that cash, they're trying to give you something to use as a proxy for a change in the industry. In the interim, we will pay you to wait for things to either get better. It's tough. These are deep cyclical industries, and oftentimes the dividend yield is what carries some of these companies through some of the cycles. So I think it's a tough position to be in. I don't envy her that position.
And many of these companies need to cut prices, not just cost. Sarah, let's get into that. Who has pricing power right now? And you can go beyond this sector, beyond Detroit. Where is the pricing power?
I don't think it's in automobiles. I mean, even if Tesla's cutting prices, it tells you that there's not a lot of pricing power in that segment. I think some of the technology stocks continue to have pricing power. I think even some of the consumer things continue to have pricing power. If you look at what people have done on the streaming side with people raising, there's Netflix raising their prices and saying, we're kicking everybody off of your subscriptions. So I think that there are places where people are willing to say, you know what, it's a small enough price per month. I want to keep doing that. Larger ticket items, I think it's much more difficult. So I think there's a pricing element to it. But I mean, even Apple's got pricing, and those are not small items either. It really depends on where you sit in the consumer's preference cascade, I guess.
Abby was talking about the prospect of broader participation in this equity market run. November's been much, much better all round. But Sarah, going forward, does some of this persist? Can you get participation elsewhere into next year?
I think that there's so much difficulty in predicting next year because there's a range of different probabilities of what may occur. If we are going to continue on the idea, which is the current consensus, which goes back to the consensus ping pong, that things are going to be fine, that we're Goldilocks and everything is going, things are going well, inflation is going to come down and we can start to see rates come down and all that will happen at a moderate pace, then you should see broader participation. If you get some of the concerns like labor is still very strong and therefore wages are going higher and margins may contract and that might be tough for earnings, I think that that's going to be a problem for everybody across the board. It's not just going to be a problem for the top 7 that we've been seeing so far. I think it really depends on how next year plays out, and I don't think that we have a real read on that yet.
You know how we typically end an interview, I talk about energy, Sarah, so let's do that again this morning. It has been tough. The underlying commodity, October, down by more than 10%. November, difficult. Energy equities underperforming. The sector on the month down by something like 1%. Does this sector, need commodities to rally or just stop going down?
I think it needs them to stop going down because it wasn't pricing in the higher costs or the higher prices to the extent that they were higher in September anyway. But I think this is, again, part of that problem of what people consider legacy industries. And the idea that we're calling oil and gas a legacy industry, sort of like we're calling the internal combustion engine, when both of those things are the majority of production, both in cars and of energy, is kind of amazing. But that's kind of what happens when you're looking at different investor manias as we go through things. So right now, these are just sectors that are not in favor.
It's crazy, but that's where we are. Sarah, thank you. Sarah Hunt there on the latest. Coming up, your trading diary. That's next.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
25 minutes into the session, equities higher here on the S&P 500 by 0.7%. Decent dev gains encouraged by the bond market. Early days, but decent dev gains. That's the price action. Let's open the calendar and take a look at the trading diary. More Fed speak. Cleveland Fed President Loretta Mester speaking at 1:45 Eastern. 2 p.m. Fed Beige Book coming out. President Biden discussing the economy at 3:30 Eastern. Tomorrow, another round of jobless claims and core PCE inflation numbers, plus an OPEC Plus meeting. And finally on Friday, main event to round out the week. Chairman Powell speaks to close out the trading week, going into the quiet period. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
On the next episode of the Business Week Show, imagination.
If no one else is going to buy and protect these buildings and make sure that people on the South Side have opportunity, is there something that I could do to try to acquire some of these buildings on my block?
You know, I feel really bad for young artists. They get swallowed up, spit out like stocks on the stock exchange.
Watch the Business Week Show Thursday nights, 10:30 Eastern on Bloomberg Television or 8:30 on Bloomberg.com or the Bloomberg app on connected TVs.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, good Wednesday morning from the offices of Build America Mutual down here in Lower Manhattan. The World Financial Center is the way I call it. I think they call it Brookfield Place now or something like that, but it's World Financial Center to me. We're at the offices of Build America Mutual. We're going to be talking to a lot of smart people down here throughout the morning, so we're looking forward to that. Coming up, we're going to check in with RJ Gallo, Senior Portfolio Manager at Federated Hermes, talk about the municipal bond market. What does he make of this move in these markets? Sean McCarthy, the CEO of Build America Mutual, he's going to join us here on site. Why not? Because it's his offices, so he'll be here. That'll be cool. David Dowden, Managing Director at Mackay Shields, also going to talk about infrastructure investing in the municipal bond market and municipal ETFs. So we got a lot of muni talk coming up this morning. And we're going to kick it off right now with Mr. John Tucker to Bloomberg Business Flash.
All right, Paul, thanks. And this is an eye popper, at least for me. So let's start with, yields. The 2-year, 11 basis points lower right now. We're at 462. So you have GDP revised up. We also had a downward revision to the core inflation index. As a result, that is moving yields to the session lows. Just maybe the economy, not too hot, not too cold. And with the expectation of rate cuts earlier than later, this all adds up to a boost for the major averages. S&P 500 up 30 points, a rise of 0.7%. We're at 45.85. The Dow's up 86 points. NASDAQ 146 points higher. That is up 0.9%. Well, it looks like the economy may be firing on all cylinders at this point. Third quarter GDP revised up to 5.2%. Economist Lara Rame at FSJV Holdco had this reaction.
Growth continues to just surprise to the upside. And to me, it's remarkable the inconsistency between talking about rate cuts to, this idea that we're going to need rate cuts in the near term to support the economy.
Well, buyback, a dividend boost, that means a revved up GM stock. Those shares 11% higher. And investors waiting with bated breath for the data that we get tomorrow. About 8:30 Wall Street time, the Fed's core PCE deflator. Again, 8:30, the Fed's preferred inflation index. And we'll check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul.
All right, JT, thank you so much. We appreciate it. We're down here at the Build American Mutual offices. I think it's 200 Liberty Street. I call World, just in the World Financial Center. It's a great, great part of town. Used to work down here back in the day. Joined today by Jennifer Ryan, Bloomberg News. You're a tech reporter, editor. What's your whole remit there?
I am now an editor on the equality team. So
the equality team.
It's fascinating. We cover corporate efforts to promote diversity. We cover student loans. We cover all manner of activities in corporate America about diversity.
Ah, interesting. Cool. So we got you. You're here for the next 3 hours, right?
I am indeed.
You made your way down to Lower Manhattan. Good stuff. We appreciate that. Good day in the markets here. I mean, again, another strong opening here to the market here. It's just interesting to see what's happening here. Let's dig under the hood here with Nora Melinda. She joins us. She is back in the Bloomberg studio in Midtown Manhattan. She's an equities reporter. Nora, what are you seeing in the markets here?
Yes, so there's a couple stocks that I'm looking at this morning. First, starting with NetApp, that is ticker NTAP. It's up as much as 15% this morning, jumping for its biggest gain since 2017. Now, that's because it boosted its full-year adjusted EPS forecast, which has topped analyst expectations. The company also reported a second quarter revenue that beat consensus estimates, and analysts are highlighting that the company's traction in new products, as well as its strength in all-flash solutions, are really powering this gain. And it's really a storage, it's known for its equipment that allows you to store and share a large amounts of digital data across physical and hybrid cloud environments. I'm really watching its Pure Storage as well, which will be reporting third quarter results after the bell today. Also, we've got General Motors, which was also looking at General Motors. That's ticker GM. It's up as much as 12% this morning. It's climbing for its biggest gain since 2020. It did say that it would hike its dividend by 33% and repurchase about $10 billion of shares. That's marking its biggest ever buyback plan on record. So that stock is really driving up. And on top of that, investors are really elated about the fact that the automaker said that it would reinstate its 2023 earnings guidance to levels modestly below what it gave prior to the 6-week-long United Auto Workers strike.
Yeah, I wanted to follow up on that auto workers strike. I mean, this is something that we followed very closely on the equality team, and I'm wondering what's the overall sentiment among investors about the resolution there?
Definitely. I mean, this new guidance that the company provided was much better than Wall Street had expected. So it is a lot of positive sentiment generating this rally. GM did say that the net income will now be between $9.1 billion and $9.7 billion compared to its previous range of $9.3 billion to $10.7 billion. So very welcome news.
It's a nice move in the stock here, and Mary Barra was just on with Jonathan Farrow, and I thought she responded well to John's question about, hey, isn't this playing into what the union always said, which is, paying off, shareholders and making executives, wealthy at the expense of the worker? But I think her response was, hey, we're allocating our capital to, where we think we need to, which is to workers. They got a big increase in pay, but we have to take care of all stakeholders. So I thought that was a pretty good response, and the stock is reacting pretty positively today.
Definitely. And honestly, in some other news, looking at GameStop really briefly, that's up as much as 22%. It's now pairing a little bit, but that stock is on track to extend its gains for a second consecutive session. And as we all know, it's been a long favorite of Wall Street. The bets crowd, as you previously remember, GameStop really pushed shares up as much as 2,700% within a few weeks back in 2021, January of 2021. So we really are seeing some options traders betting that GameStop will jump 50% in a little bit over a week. So that stock is rallying as well.
All right, very good. We appreciate it. Nora Belinda, thanks for giving us a couple of minutes of your time. Lorman, and she covers the equities for us. And again, we've got a good start to the day, some green on the screen here. Big movement in rates, Jennifer. We had the 10-year at 5% just a cup of coffee ago, as Tom McKean would say. Now we're down to 4.26%. Just a big move in the bond market and the equity markets.
It's such a big swing, and you've got to wonder, is that swing really something that is rational at this point? Or is it something that can stick around, or is there going to be some more cold water thrown on the market, when we get some more economic data coming up this week and next week?
Yep, absolutely. Got some big inflation data tomorrow. We'll be on top of that. All right, let's check in with RJ Gallo. He's a senior portfolio manager and head of the Municipal Bond Investment Group at Federated Hermes. They have a couple shekels under management, folks. Trust me on that one. Big fund out there. RJ, what do you make of this market really in the month of November? Big moves in rates, big moves in the stock market. What do you make of it?
Well, you summed it up. Big is appropriate. The Muni Bond Index, the S&P Muni Bond Index is now up almost 5% for the month of November. The Bloomberg Muni Index is over 5%, 5.3%. Yields on the BVAL series, looking at the AAA Muni yield curve, the BVAL shows the Muni market having rallied from 75 to 82 basis points all the way across the curve. It has been striking. I would note, I think for quite some time there was so much hand-wringing about the Treasury borrowing. There was so much concern that some people were talking about the 10-year going to 6. The market had gotten way too bearish. When the 10-year was at 5%, it was unlikely to stay there because the economy was about to roll over. Even modest signs of weakness, some deceleration in jobs, the ISMs were a little slower, the inflation numbers came in a little bit better, and we've had a massive bond rally. I think positioning has a lot to do with it. I think that the fundamentals are playing in the hands of those who are more constructive on bonds. That's where we've been all year. So we've been happy to see this. I worry, however, it might be overshooting a little bit at this point.
Let me ask you, just sticking to the bond market, overall fixed income, what's the best relative value play? I mean, you mentioned there's been a huge move in munis. I mean, is that sort of done, or are we going to see more demand next year?
Well, I wear a couple hats at the company. I'm the head of our duration or interest rate view, which we manifest in our actively managed funds, of course, and I'm the head of the muni bond group as well. So focusing a lot on rates and a lot on munis. Big picture, we've been up in quality within our taxable space. That actually hasn't worked as well. The soft landing expectation has been fueled by the recent data series that have been coming out. Spreads have done relatively well. Risk assets have done relatively well. Looking forward, we're still debating whether or not we're going to have a soft landing or even a mild recession. Either way, that's, on a duration standpoint, you should be neutral to long. You should be taking some duration in your portfolio. Hiding out in cash doesn't make a lot of sense. Cash has been an excellent return for investors in 2022 and much of 2023. But already we're seeing that the opportunity to take some greater fixed income risk by going out the curve is there. And we've been counseling our clients and our shareholders to do that. But in terms of relative value, like I said, up in quality, underweight investment grade, underweight high yield, on the expectations of a slowdown in the taxable space. In the muni space, we've been a little bit more constructive. The muni market can be very technically driven. And when the rate environment has improved as it has in November, that tends to bring about flows, and that lifts all boats, even the lower quality buckets of munis. So we're taking some shots on mid to lower quality credit and munis within our funds.
RJ, have we seen peak rates?
Yes, I think we have. I think that
nice and distinct. So
yeah, I don't mean to be overly definitive.
So where do you think
the markets are full of uncertainty, but I do think that we saw peak rates that when we got a little north of 5 on the 10-year, that was an oversold market. And I think that the economy's deceleration and the prospect that the Fed will be easing sometime in the next 12 months, maybe not by May, those all suggest that yields should be stable to lower from here. The big question is whether or not we get a soft landing or a more significant economic downturn.
So if we're seeing a slowdown now, then the next question is, what's the Fed going to do about it? I mean, we've seen a variety of forecasts coming out about when the first rate cut's going to be, some as early as the first quarter. What's your take?
Yeah, I was trying to preview that in my last comment there. I don't think it's a first quarter easing. The economy's had obviously posted very, very strong growth in 2023. The third quarter was a blowout north of 5. Nominal GDP is astronomical. I don't think that's suddenly going to turn on a dime. The Fed is going to ease for one of two reasons. One, to secure a soft landing, they have to ease a little bit. Go back to the mid-90s. That's exactly what happened after the 1994 aggressive Greenspan hiking. They ended up easing 95 and 96 to secure the fabled soft landing, which actually took place. That was a soft landing. They're very rare. If, in fact, we're going to repeat that, if we get a soft landing, which is still sort of questionable, it has to involve the Fed easing. The Fed funds rate should be not be north of 5 to support a soft landing. The equilibrium Fed funds rate is probably higher post-pandemic for a bunch of reasons, but it's not 5. So the Fed would have to ease a little bit, a couple of times probably to get into the mid to low 4s even in the event of a soft landing. If, in fact, we have signs of a recession and the inflation dynamic is very well behaved and heading towards 2%, then the Fed could ease more. That's why I think the key question for 2024 is whether or not we can actually achieve a soft landing. I think the deceleration's in the market. The question is, how intense is that deceleration?
Well, I'm looking just a GDP annualized number today that got reported, 5.2%. That's up from 4.9% last month, and the consensus was for 5%. So very strong GDP number. The PCE deflator inflation data tomorrow, consensus is 0.1%. So it seems like everything is working. And I guess Bill Ackman, he sees those numbers and he says, I think this Fed's going to start cutting rates.
Yeah, I think Bill might be a little bit ahead, certainly ahead of the markets, and I think obviously he gets a lot of attention and has a lot to do with why the market's doing what it's doing this morning. I think partly reacting to his views. He's been a very astute investor. That said, this Fed had to labor mightily to offset the transitory error that they committed early on. When inflation was becoming a major problem, the Fed was very slow to react. they had to make up for lost ground, reestablish inflation fighting credibility. I think they've made great progress. A lot of the inflation was due to the echoes of the pandemic. It wasn't just because of monetary policy. That said, monetary policy had to react, and it did very forcefully. I don't think the Fed's going to abandon that perch rapidly. And if the economy still is expanding, i.e. has GDP 1 to 2%, close to potential, and the unemployment rate has a 3 handle on it, I don't see the Fed rushing to ease. The Fed's own dots make it clear that the policymakers do not require that the PCE fall to 2% before they ease. The dots have eases before you get to 2%, in other words. But those are all conditioned upon some weakening in the labor market as well. The December FOMC meeting will be very interesting to see a refresh of their projections. Dots are not promises, but they provide very clear signals about how the policymakers are looking at how they manage the challenges of their dual mandate. Those challenges have been very single-mindedly focused on inflation fighting for a while. Now they have to sort of weigh both.
Traders again.
The labor market.
I'm going to place stop loss for our Bitcoin, and the price I'm looking to sell, if it change direction, 37,888. Let's do it this way. 37,888. It will give us 0.5%. In our terms, it will give us 500 pounds. Okay. So if you decided to copy this trade, please place stop loss so you will not lose any money. You will be in profit. And this way, this is how we trade. This way you will secure your profit. Okay. If it will move lower, what I will do, we will move our profit even further. Okay, guys, stay cool, stay safe. I'll speak to you later.
Through the COVID era relief packages that is nearly exhausted for most households, especially for mid and lower income households. And as a result, the consumer is probably excited to have a nice Christmas, but they're going to be retrenching going forward. That's one of the key drivers of the economic deceleration that we expect to unfold in the current quarter and into 2024.
Right. Hey, RJ, thank you so much again for joining us. Really appreciate getting your thoughts and insights. RJ Gallo, Senior Portfolio Manager and Head of Municipal Bond Investment Group at Federated Hermes, located in Pittsburgh, Pennsylvania. S&P 500 up 0.3%. Let's get some company news right now with Lisa Mateo.
Thanks, Paul. Bank of America paying up for submitting false mortgage lending information to the U.S. government. The Consumer Financial Protection Bureau, it says the lender has agreed to hand over $12 million in fines after some of its loan officers failed to ask mortgage applicants for their race, ethnicity, and sex from early 2016 through late 2020, and then falsely reported that customers declined to provide that information. In other news, Goldman Sachs may have a way out of its credit card partnership with Apple. Bloomberg's Gina Cervetti has that story.
A source tells Bloomberg News that Apple recently took a first step towards severing the contract, but the iPhone maker remains committed to its Apple credit card and savings account. Goldman Sachs has been pulling back from a move into consumer lending after it proved to be more expensive than expected.
Apple right now up a fraction, Goldman Sachs up about 1.5%. Miriam Adelson, the widow of casino magnate Sheldon Adelson, is selling $2 billion of Las Vegas Sands shares to help acquire a majority stake in the Dallas Mavericks. Bloomberg's Simone Foxman has more on what's moving the stock.
The offering for this $2 billion worth of shares priced at about $44 a share. That was a 7.7% discount to the closing bell price. And the term sheet said some investors wanted a discount of as much as 10%. Of course, the company, though, going in and saying it's going to buy back $250 million worth of shares as part of this offering.
Now, Foxman says there are no major changes at the company. Adelson still remains a controlling shareholder. Right now, Las Vegas Sands shares, they're down about 3.5%. Those are the company stories we're following this hour. We'll have more Bloomberg Markets in just a bit. I'm Lisa Mateo, and this is Bloomberg.